at 10:08. Let's convene the Mendocino County Retirement Association into order, and Craig will lead us in the pledge of allegiance.
Pledge allegiance to the flag of the United States of America, to the republic which stands one nation, under God, indivisible, with liberty and justice for all.
So the first thing on our agenda is public comment. Members of the public are welcome to address the board on subjects both on and off the agenda. The board is prohibited from taking action on matters that are not on the agenda, but may ask and or briefly answer questions. Do we have any members of the public who would like to address?
No, hi everybody.
Okay. Next on our agenda is the consent calendar, which is minutes of the August 15th board meeting, August 2018 retirement report, and the preliminary monthly financial report. Are there any comments or corrections to anything on the consent calendar?
I move we approve the items on the consent calendar. Second.
Then by unanimous consent, they'll be approved. Okay, then we have a discussion of possible action regarding investment matters. First is quarterly investment report.
Thank you, Mr. Chairman. Our investment consultant, Callan, is here with us today with a laundry list of things to discuss: the quarterly investment report, an update on Harbor, the preliminary monthly report, and then some education on real assets. So with that, I'd like to turn it over to Greg and Jay. And we all know Greg, but he'll introduce us to Jay again. Take it away, guys.
Great. Well, thanks for having us. It's a pleasure to be here in Fort Bragg. We came up last night and had a great time staying here and then checking out the harbor. So thanks for having us. So I'm Greg DeForest. I've met with you all for the last 9 years as your investment consultant, and I manage our San Francisco office, and I've been working with you about 9 years. Over those 9 years, we've done a few asset allocation studies for you. 2 times we've done a study. Jim Van Hewitt has come up, and then John Perone came up most recently and did it. And those people report to this guy here, Jay Klopfer. Jay's the head of our capital market research group. He has been at Callan as long as I have. We both joined in '98, so we're going on 20 years now at the firm. And Jay, being the head of our capital market research group, he's an economist by training, but he, so a few of the things that his group does is they come up with long-term asset allocation assumptions. That's used in all of the modeling for our asset allocation work. And then his group also does manager structure work. So after John Perone came up here and did the asset liability study about 2 years ago, we went through each asset class and said, okay, is this lined up the way we want it to be lined up? So we did domestic equity, we paired out a couple of the managers, we did international equity, we decided we needed to add international small cap at EM. We did fixed income, said it looks good, and then we did real estate. And when we did real estate, we said, okay, as it goes for real estate, it looks fine. You've got 2 core real estate managers and then the Kings Court property. But what we didn't do is we didn't broaden it out and say, what if you looked at other real assets? Real estate is a subcomponent of real assets. And we thought, okay, at this time, let's take a look at real assets and see if there are other asset categories that you can consider for the investment portfolio. So to level set everyone, and Jay will go through this, you currently have a target of 9% to real estate, so 22% fixed income, and then the rest in public equity. So you've got a lot of exposure to the equity market and the public markets in general. So we're going to take a look at real assets and say, okay, if we broaden the definition of this beyond just real estate, what other asset categories can we look at? At the end of the presentation, we're going to say, okay, if you did this, what would the portfolio look like? How could you actually implement this? So we'll have specific scenarios for you to consider there. But what I think the process is most likely going to be This will be educational. We'll show you, okay, how could you implement it? And then in the future, we'll probably do another asset liability study if you want to, and then you can consider it there as well. So that's Jay, and that's going to be Jay's presentation. After Jay's done, I'll go over performance for the plans for the quarter and then for month of August. Any questions before we get into it? All right, let's talk about Jay's presentation.
Okay, great. Good morning, everybody.
Morning.
Nice to be here. We have a presentation. You all have it on your iPads, I believe, titled Real Assets. If you can start on page 2. As Greg mentioned, when you look at your target portfolio, actually your real estate target is 11, not 9.
Did I say that?
You said 9.
That was the old one.
Yeah, you misspoke. I just earned my keep today. And the idea, as Greg mentioned, the idea is that you have a lot of exposure to the public markets. Your fixed income is all public. Your equities are pretty much all public. So one of the notions of looking at broadening out the real asset portfolio is diversifiers. And so we'll talk about this from a couple of perspectives. One is you could have more in real assets is one thing to consider, and then consider other types of investments within it that might diversify the whole portfolio as well as the real assets. I will take a moment to talk about the different real assets because it can be a little confusing. What's a real asset versus an unreal asset? Is that what we're talking about here? And hopefully they'll all come alive. On page 3 is your current real estate portfolio. You have target allocation to the 2 managers you have now. In dollar terms, you have the actual allocation on the far right, pretty close, but it's $56 million in a target, so 11%. It's benchmarked to something that's got a lot of letters there, the NCREIF, NFA, Odyssey, Equal Weight Net Index. What is that? It's really a collection of investment properties out there. You can't really buy the index, but it's very representative of what others like you do when they invest in real estate. So it's a pretty good measure of what's going on. As we talked about, as what Greg spoke of, you up the real estate allocation after the last study, 11%. We think that's pretty reasonable. It's right in line with many of your peers. But you might consider what others have done, which is broaden out the definition of real assets and consider other strategies that might fit. You don't have to, it's just worthy of consideration. So that's our starting point. So let's talk about a couple of different ideas. What do I mean by other real assets? There's really a couple of categories. So one is there are liquid public market strategies that are considered real assets. I'll talk about those. Any one of them might be a little bit frightening on its own, so the idea is they're bundled together as what's called a real asset portfolio. I'll talk about that as a separate item. Second, you could consider private timber lands. You're actually owning part of a timber property, and so the asset grows and it gets harvested and you receive income. In a similar fashion, there is farmland. There's another type of investment. And then finally, there's the notion of infrastructure, and that one holds great promise, in my opinion, for looking forward. And there's a variety of ways to get at that. And what do we mean by infrastructure? Well, it's been in the news a lot, but it's sort of the basic plumbing of the economy. So it's roadways, it's airports, it's water systems, it's energy and energy transfer mechanisms, so pipelines and other types of things. And it's a very interesting phenomenon. I mean, they're assets that are already in the economy, but the notion of they have unique characteristics that might make them quite appealing to institutional investors. So those are the rough categories again. So a bunch of public assets gathered together, timberland, agriculture, and then the notion of infrastructure. So hopefully, I'll try not to use too much jargon. There's a lot of language that gets thrown around here. So let's talk about the real assets. And first, the big picture. So if you turn to page 5, why are you even considering real assets? What's the notion here? You're looking at investments that you believe will do well if inflation moves. And there's two movements we're worried about. One is, what if there's a spike in inflation? And what if inflation just gradually rises? We haven't seen inflation much for pretty much all of our working lives. So it's kind of hard to get your arms around it. The last time we saw very high inflation numbers was the early 1980s. We had a spike in 2005 and 6. It got up to about 5%. And then with the advent of the global financial crisis, just dropped back to 0. So we really haven't experienced much in the way of inflation, but it could happen. And the idea of a real asset is that maybe it'll respond well or help protect the portfolio. To me, it also is a potential diversifier. So as you consider real assets, I try to apply what I call the investment Hippocratic Oath, which is, first, do no harm. So if you're going to consider an investment, can it help in a real, in an inflation environment? Well, what if inflation doesn't show up? Could it still help? And that's where you look at the notion of diversification. So there's some characteristics listed on page 5 that we look at for real assets. So 1, can it help diversify? 2, these investments typically have a steady income stream. And if you have a steady income stream, so real estate's a good example. You own a property, it generates rent. It's a very steady income stream. That doesn't move around nearly as much as the value of a stock. So it's very steadying, if you will. Also, the notion is if inflation takes off, you'll probably get to charge more for that property in terms of rent, so it may rise over time. There can be a capital appreciation potential, so there's a growth element to many of the real assets, just in the same way there is for stocks. Can be a potential for higher risk-adjusted returns, and what that means is they don't move around as much, and if the return is steady, you actually get to accumulate more dollars. So if you have 2 return streams that have the same expected result, but the volatility of one is lower, you'll accumulate more dollars with that. So it can be a very appealing characteristic. And then this notion of if you have unexpected inflation, what can help you? And if you have trending inflation, what can help you? Now, let's take a step back real quickly. Let's look at stocks and bonds. How will bonds do in inflation? Probably not very well, because you're expecting a stream of payments back for loaning somebody money. And if inflation is going up, you're going to want a higher and higher yield to compensate, which means the value of the bond will go down, or they'll get bid down by other investors. So nominal bonds are not great inflation hedges. In fact, they don't do well at all. What about equity? Well, equity is a claim on the economy. So over the very long term, equity is actually a reasonable inflation hedge, in my opinion. So in some sense, you already have some inflation protection built into your portfolio through the equity exposure you have in there now. You also have real estate, which has some of these attractive characteristics. So we're talking about changes, really, enhancement changes, I wouldn't say on the margin, but incremental, if you will. One of the measures we look at on the short term is on page 6. It's this colorful bar chart here. Beta is a common term used in capital markets, and it's a measure of how much does something move with a particular market. So all we've really done here is tested if inflation moves, how do other asset classes typically move? And this is over a shorter term. So you can see that you get down here to commodities, which is I'm not really good with colors, but that are not quite emerald green, but forest green. Is that one? The one that sticks out the furthest to the right. Commodities tend to move, be very responsive to inflation. And the way to read these numbers, I've got it described here. $1 worth of commodity investment has the potential to provide more than $4 worth of inflation protection. So that's how you read this number of beta, 1 versus a smaller number. Interesting challenges, I've circled them on my own piece of paper here, but you start at this dark purple number here, which is inflation, or real estate. These are more private investments. They don't seem to offer much protection in the short term, and that's correct, because they're not valued daily the way a stock is. So you're kind of comparing apples and oranges. So right off the bat, if you want protection at a very short-term basis, you're going to need something that's going to have an immediate response to inflation. Private investments are not going to have an immediate, but they're more likely to have a cumulative, over time inflation protection. So that's just something to keep in the back of your mind. So as you're thinking about real assets, what are we hoping to protect against? A sudden spike in unexpected inflation, or a gradual rise in inflation through the economy? I would argue B is more damaging to your portfolio over time, and that's the one we're really going to be focusing on. Okay? Performance characteristics is a bit of an eye chart. I apologize for that on page 7. But suffice it to say, as you look through, these are various, there's a lot of letters here, but the way to read this down, I've highlighted real estate in green. That's just private real estate like you have now. Farmland, timberland, and then this is a measure of public infrastructure. So those are the 4 areas we're talking about, or 3 of the 4 areas we're talking about. The components of a real asset portfolio that's publicly traded are below that developed infrastructure for the most part. If you look out, let's pick a column that might be worthwhile, say 10 years. So you're fourth from the right. So you can see that they do vary quite a bit. Farmland has actually done well over the last 10 years. Timberland, not as well. Developed infrastructure has been something in line with equity. The point is, the ones that are more publicly traded tend to have a very high standard deviation, just like equity does. So if you look on the second from right column, REITs are stocks. MLPs are stocks. The one that's labeled FTSE, developed infrastructure, those are listed infrastructure stocks. They have stock-like volatility, so it's in the teens. The private markets ones don't move around as much because they're only valued once a year. And even then it's an estimate because they don't turn over. So it's a smoothing effect on the portfolio, which can be very appealing over time. But it gives you an idea of where the results lie. So TIPS are more like bonds, they give a more of a bond-like return in risk. The private markets are more like other private markets, so real estate in particular, and then the publicly traded markets look like stock. So just so you understand the level set of where those returns come from. So page 5 is the discussion that we've already outlined. You can consider page 8, excuse me. I need your glasses. It looks like a 5 sometimes, don't you think?
Yeah, the B.
To consider adding real asset exposure. First and foremost, we believe real estate is a great core holding for any real asset portfolio. And if you just retain real estate, that would be fine. So again, this is incremental to that. I mentioned the 4 basic categories. They're the third set of bullet points down. One of the driving characteristics of this is how much does it change the risk and return portfolio for Mendocino. You've already decided on the appropriate risk tolerance doing an asset liability study. So we don't want to move you too far away from that just by adding another asset class. And so we look at, ultimately we're going to look at 2 options. One is keep the 11% and maybe diversify some of that. Or second, add to the real asset exposure. So retain the 11 plus add maybe a little more, go to 15. And that would not also be outside the range of what we see other public funds do. Okay? So now I'm going to take a minute to touch on each of these notions. I'm going to give you a big picture and then we'll dive into the last of it. So the first part is on diversified public real assets. So let me define this really quickly. The notion came about 15, 20 years ago that, okay, what publicly traded assets might you posit that would have a better relationship to inflation? So a couple of them. One is there is a notion called inflation-linked bonds. In the US, they're called TIPS, Treasury Inflation Protected Securities. Outside the country, they're just generally referred to as global linkers. A second would be commodities. And in this case, you can buy commodity futures. There's an index of them that are very inexpensive to buy. It's like buying stock futures. They will move a lot with commodity prices. But if there's a rise in energy prices, for instance, they're going to track it very closely. A third would be real estate stocks. So REITs, real estate investment trust stocks, that are a publicly traded version of what you own now. And a fourth would be inflation-sensitive equity. It's typically materials and energy-related stocks. And the idea was if you put all those together, I mean, they're a subset of what you already own in some sense, the stocks and bonds. And well, maybe commodities is the biggest difference. But perhaps that will give you some protection in the event of rising inflation. And so there are a collection of these strategies available in the market. What's interesting to me is that they're kind of all over the map. There's very conservative ones, there's very aggressive ones, there's some that have nothing but stock and some that have half in inflation-linked bonds. So it'd be a case of picking the right spot for you. But the underlying components are depicted on page 10. And they're comparing them, they're compared to stocks and bonds. So right in the middle of the page is US equity. So you can look at it as the return and the risk chart over 15 years. So you can see that some of these on the right, MLPs, they're a stock. It's a master limited partnership. They're typically pipelines and pipeline-related infrastructure stocks. US REITs, global REITs, all have more volatility than the stock market because they're more concentrated. But they have comparable return. Commodities, look at those way down there. Why would anybody buy commodities? It was much risk as a small cap stock, and at least they've had a negative return for the last 15 years. They are incredibly uncorrelated with pretty much anything else. So one of the lessons of capital market theory is something that's not correlated with the rest of your portfolio is a wonderful diversifier. It's just that you may go through long periods where they don't look great. One of the reasons why these public real asset portfolios are popular is because just going out and putting commodities in your portfolio is going to expose you to quarter by quarter a lot of regret risk. And why do we have this again? It's doing terrible. How do I justify this? It's a diversifier. Some of the other, and then you see tips over on the left look much more like bonds. So they move around a lot, and the notion is it's kind of like a subset of your already diversified portfolio with an inflation focus, if you will. So there are multiple asset class strategies. Page 11 gives you this description that I've already spoken of. And the managers out there offering these products have some track record, not as many as you would expect, but they do, look, they're all over the map, so you need to be very careful as you select one, which one's more aggressive, which one's more conservative. We've done a bunch of searches in this space, and everyone tends to be very customized in terms of trying to figure out what's right for your individual portfolio. There's some considerations and benefits listed on page 12. To me, the benefit to these is there is a volatility inherent in commodities and in tips and in stocks, and you can capture some of the benefit of that volatility by having this disciplined, rebalanced collection of these particular investments. It can be a little bit heady, the concept of this volatility capture, I understand that, but it can be quite appealing. It also gives you some comfort in that, okay, if there's a sudden spike in inflation, these are things that are the most sensitive, okay? But the considerations, again, they're all over the map, so you need to be very careful as you select and as you benchmark. I think even more telling, if you look on 13, these are products, these are exposures to asset classes over time for 4 different types of products that are in the market. They're not at all alike.
Can you define those 4 terms, please?
Yes, I can. So conservative in this case here would be a lot of fixed income. So the green part that's taking up the most of that chart is tips. So Treasury inflation protected securities. Aggressive, if you look on the right, there's very little tips. And there's a lot of the other investments in there. The purple is diversified commodities, so there's a lot of commodity exposure in there. And a fair amount of energy equity, which is the blue at the bottom. Balanced on the lower left, this is a portfolio that doesn't change its weights hardly at all. So it's like you get a fourth of each, and that's what it's going to be. And then tactical on the lower right means that someone is imposing their model and their expertise to say, we're in commodities now we like tips, and they will move over time on your behalf. So again, there's different flavors and there's different levels of aggressiveness within them. So benchmarking can be a challenge. I put this gobbledygook up here on page 14 to show you these are the benchmarks I've seen for a handful of products. And they are all over the map. It's pretty hard to compare one to the other. So I would just be cautious. It's not that we don't like these. We like these a lot, but they're really specific to a need. Okay? Where do these come in handy is we see them actually used in one place in defined contribution plans as a way to offer an inflation hedge for participants. 2, it's a way for smaller plans to put in some measure of inflation protection when they may not be large enough to handle a private investment. So those are kind of 2 of the options. 3, though, we've seen with some of your peers, some funds your size or bigger, use them because they've been unwilling or perhaps not comfortable with moving into other items, other private investments in real assets, but they wanted some diversifier. Okay. You can see the risk and return comparison on 15, comparing those 4 that I talked about, the aggressive, a balanced portfolio, a conservative, and then I say passive number 2. There's the problem is these were 2 different passive portfolios, but they're roughly the same. They're really the ones that just kind of don't move around a lot. They can be quite, they can do quite well. The tactical portfolio has done well over the last 5 years. but if I were to extend this out further, it may not have. The problem is anything beyond the really simple balanced ones don't have long of a track record. You're talking 5 to 10 years at most. The point of all this, and we come back to page 16, is that there's a lack of homogeneity across these products. So you just need to be very careful as you select them. I think they can play a very good role in a particular situation, especially if you're unwilling to look at other strategies that might be complementary to real estate. But there's a certain decision would have to be made. Do you go off the shelf and pick from one of this range, or do you ask to be customized? We've seen both. Do you want it value added from the asset allocation decision, so tactical or not? Do you want active management involved? So there's a lot of the decisions you've had to go through with your equity and your fixed income portfolio, just in a sort of a subset of that. And then really at the bottom, this is the question I think is worthwhile asking. What are the true diversifiers in these portfolios? Tips and commodities. They're also the least appealing from a return perspective when you look at your total portfolio. So it's the one with low return and a lot of volatility, and the one with low return and less volatility. But they're the ones that look the most different from the rest of your portfolio and the most different from real estate. So they give you the most diversification bang for the buck, but they can be a challenge to hold. The other asset classes, and this is Greg and I had this conversation about this for these diversified real asset portfolios, is you already have a lot of public exposure. And to us, it would be interesting and worthwhile. Our suggestion for you to consider is maybe you want to consider something that is different from your public exposure now. So that's sort of the summary as we've looked at diversified real assets. Yes, sir.
Up in your panels, you show loans as part of the portfolio, but you don't, on 15, I don't see where you've broken out loans secured by real estate as part of this segment.
No, I haven't seen real estate loans used as much within these portfolios.
So we have a chart in here that shows bank loans.
Bank loans, right? They're a
So
little different.
bank loans are floating rate private debt to companies. So it's corporate debt that flows.
Well, I'm talking about secured real estate loans,
Sure.
not corporate loans.
Right. So the chart that on page 10, the bank loans there, that's a specific asset category. When we say that word, we mean credit. We mean corporate loans as a component. And people like that because of its floating rate nature. So the thought process is, if there's high inflation, then the Federal Reserve increases interest rates, which means the yield on floating rate bonds goes up, and therefore bank loans should be a good diversifier in a high inflation environment.
Well,
So Lee, that's different from what you might be talking about, which is
CMBS, I think, for the most part.
well, no, just secured direct real estate loans.
Mortgage, right?
Mortgages on properties like this.
yeah.
And, like yields on that in the university endowment space and foundation space, they're making about 6% net on those investments.
Mm-hmm.
And that's, way above everything else you've got here.
Yeah.
These are like fixed for 5-year terms, so rather than having a float at a lower rate, you get a fixed rate for a longer term.
Yeah.
The only problem is you have payoffs. You have a lot of payoffs in them. So you
Right.
have a
You get the
little bit of management.
reinvestment risk, yeah.
Right.
Yeah.
But, to me, I can't do any of this with these guys because I'm in that business, but
Yeah.
the foundations and endowments that I represent absolutely love mortgages because, they give them a high yield and without any volatility.
Yeah.
Right. They don't think of them.
They've had no risk.
Right. They don't think of them as a real asset, though. It's a diversifier to the rest of their portfolio, no doubt. But they're not thinking in this framework.
Yeah, the fixed income category, but it's kind of real estate related. And
Yeah.
if you're talking about commodities, that's even further away from
It
real
is.
estate than it is direct real estate lending.
That's right. That's right.
I guess we would consider the mortgage piece more part of when you looked at your fixed income portfolio, as opposed to what's a diversifier to the real estate and and the real asset side.
Yeah, but if you can include commodities in this, then
Sure.
secured loans are closer to real estate than commodities are.
Yeah.
So I have a question on the mortgages at least like you have. So if they're paid off every 5 years, they're paid off over a relatively short period of time, and if there was inflation, presumably the new loans would be at a higher rate. Is that the case?
Or lower.
If there was inflation, you would have loans at a lower rate?
Oh, no, I said or lower if you didn't have inflation.
Yeah, but I'm saying, but if we had some concern that we could be entering into a period with more inflation than we've had, and certainly the trade wars are looming large there. It seems like that tool could also work as a hedge against inflation, because you could then, as inflation occurs, your new loan would be at a higher rate, presumably.
Right.
Yeah, it could, although I would argue that aside from tips, most bonds are not going to do well if inflation takes off, even mortgages.
So,
It all depends.
Once you
If
hit
got tips at 2 and you got mortgages at 6,
Sure.
you could suck up a lot of,
Yeah.
the worries are not so great over
Yeah.
only a 5-year window.
so if the bond matures in 5 years, 5 years from now, you'll be able to invest at a higher yield because there's inflation. But the market value of the bond goes down immediately when inflation is high. So if inflation is high in years 2 and 3, the value of your bonds go down to reflect a higher inflation until you get to year 5. So reinvesting at year 5, inflation will help you, but in years 2 and 3 and 4, it hurts you. So we're trying to look at asset classes that would do well, in theory, in years 2 and 3 and 4, as well as years 5.
So in other words, they would suffer some capital loss waiting for those bonds to mature.
So just to kind of reframe what we're doing here, so today we're talking about real assets. What sort of real assets can we consider? Jay's going to go through 4 categories. The first one, he already had, public real assets, diversified portfolios. They're not our number 1 recommendation for you. They're our recommendation to you if you don't like anything else.
There you go.
Okay, so now Jay's going to go through some other ones, timber, farmland, and infrastructure. And just give you a sense, okay, what are these asset categories and are they of greater interest to you?
Right. Timber is an interesting category. What do you mean by timber? What you're really owning is part of an operating, a portfolio of operations, if you will. You own the land, trees grow, they're harvested, you sell them, you get income. Typically, they're run by investment management firms that specialize in timber. There's a handful. I have some numbers in here to give you how many there are. This is the source of return is these get called the biological bond. If the timber prices aren't good, you can hold on to the trees. They'll grow another, they'll get bigger, they'll get taller, and you'll have more to sell later when maybe prices recover. The challenge is you could be waiting for a while, so you may not actually see any income come back if the markets aren't good. But they're tied to the broader economy, so timber doesn't do well when the economy is slow. It should do better when the economy is doing well. The investable timber universe is the U.S. There's also some overseas markets that are available to institutional investors. And then there's, there can be, what are the sources of return? The timber price goes up. There's the land appreciation. There's this notion in timberland called higher and best use. Timberland can be converted to urban use, in which case the trees get harvested, the land goes up in value, you sell it, you exit that particular piece. All right, the benefits and the considerations are on the next page. Timber is an interesting asset class in that it can be somewhat difficult to understand. It has a very long time horizon. Once you start in, you're looking at 10, 15 years. Long holding periods. If the universe of what's available is not particularly large, but typically the large plans are the ones investing in it. So this is kind of an odd little mismatch of need to be large enough to fully understand and get in, but then you can't really take big positions. So CalPERS can't take a big position in timber. It does have very low correlation with asset classes. It can have a very phenomenal income return. And the notion would be there's an inflation hedge built in. But there's a lot of challenges to investing in timber, and it has been challenged over the last 10 to 15 years for our clients who have been in it. And so there are limited availability of investments. The economic risks are quite different from the rest of the asset classes. It makes it a diversifier, but there's price volatility, there's supply and demand risk. There's a risk of overpaying for the asset just because you want to be in it. And then there are other types of, there's the environmental risks that go along with it. And then the fees tend to be quite high relative to your other investments. They're typical of other private investments. If you turn to the last page in this section on 20, there's about 9 international managers and about 25 total managers. The challenge is that the timberland is, there's an uneven set of contributors. There's not really a good index to say, here's what you'll get. Over the last 5 and 10 years anyway, much of the return has been unrealized. So they haven't been harvesting as much. You haven't been getting the income, so you're waiting for the return to come to you. Again, I mentioned very illiquid. And then the size, there are commingled funds available. The minimums are not that large. So it's certainly available to a fund of your size. To have a separate account requires a substantial commitment. How beyond would you be willing to consider? And then there is a chance you can go in through the public markets, but as far as our understanding goes, there's really only 4 securities out there. So it's probably not the best avenue for exposure. To me, timber has had a lot of promise, and it's just not really executed on it. And there's been some disappointment amongst our client base with their timber exposures. But once you're in, getting out is a long and laborious process. So in theory, it has a really fabulous diversifying aspect to it, but a little bit problematic in our opinion.
It also seems like potentially it's not diversifying our situation because it's still a significant share of the plan sponsor's revenue and it's a substantial part of the economy. And so that's part of what props up the plan is the economy in Mendocino County. And yet if we had some of our portfolio tied to that same market,
Yes.
or more than we do now,
Mm-hmm.
that it just seems like it's not advancing diversification.
That's an excellent point. And that's been the argument. We work with a lot of land trusts across the West, and they have similar issues. They're getting a lot of their revenues and their royalties from land, from trees, etc. So they're like, no, maybe that's not going to work for us. Farmlands.
Jen?
Yes.
I want to piggyback on the chair's question there. I recently heard someone say, speaking specifically to real estate, that plan that owns its own building is not as diversified as it should be because you've got assets, even though it's a small part of our portfolio, there are assets tied up there that have a lot of correlation to the plan sponsor because it's all right there. What are your thoughts on that? Does Callan have a position? Should we consider the idea of selling our building? I know it's a small piece, but
Sure.
anything that moves us in the direction of being more concentrated is not a good thing. So,
Sure. You're not unusual to be a public fund that owns its own building. It's just not an unusual position to be in. I think the size matters a lot. The fact that it's small relative to your total real estate and your total portfolio would make it less concerning to me. What we do see is public funds in a particular location focused on real estate in their locality, which we do find a little more troubling because that's a very concentrated portfolio. So when we think of real estate, sorry to use air quotes, when we think of real estate, we think of broadly diversified across building type and geography. So to concentrate for any reason without any specific knowledge, we're not sure that's a bet that can be paid.
Just so everyone knows, that the King's Court's valued at $1.1 million, which represents 0.2% of your assets. So it's a very small percent of your assets. We don't think there's a big economic risk for you. But a lot of it, Jay mentioned that other public funds do own their property And a good percent of those, they own other properties directly too, so they have an infrastructure, like staffing to take care of properties, right? That's what they do in part. If you don't have that infrastructure, why are you, like, I could see someone making the argument, okay, why are we spending our energy and time owning and managing our property as opposed to just renting? There's probably an economic exercise you could go through to say, okay, is it cheaper for us to rent than to own? That's a distinct argument, but it may not be what you want to spend your time doing. To me, that's a equally important argument as well as the concentration factor within the portfolio.
Great. I'll hit one more, two more categories here, and then we'll get to the summary here. So farmland is an interesting development for institutional space. Institutional ownership of farmland is still very, very small from an institutional investor perspective. What are we talking about here? Investments in prime cropland, orchards, and vineyards. So another way it's distinguished on this page 22 is row crops that are planted annually versus a permanent crop. So think of orchards versus grain or vegetables. It's a very small asset class at the moment. If you turn to page 23, there's some benefits and considerations. To me, the considerations here are significant. There's management involved. Clearly, you need somebody who understands how to farm and then how to manage farm land. There's water resources characteristics that are very interesting. And then right now there's only 3 players, or there's more than 3. There had been only 3 players for a long time. There's about 10 now. We're familiar with all of them, but there's really only about 5 that are viable for institutional investments with our clients. And the fees tend to be quite high. It offers a lot of promise. We wrote a paper on this about 10 years ago, and it just hasn't been quite yet fulfilled, in our opinion. So there's, on page 24 lists the summary there. It's not quite as illiquid as timber. We're not talking about 10 to 15 years, but there is an implementation timeline to get it going. There's our concerns that it's really not a very deep opportunity set yet. I think it still holds a lot of promise. The final segment I want to talk about is infrastructure. Turn to page 26. This is an area to us that has probably the most appeal for Mendocino. And so what are we talking about infrastructure? The basic plumbing. There's a list on page 26 of all the different main categories: energy, power, transportation, water, communications, and then social. What has gotten the most traction thus far has really been on the transportation side. You hear about airports being built, about seaports, railways, roadways, as well as energy. Okay? Why would you consider it? If you turn to page 27, there's really a couple of characteristics that are very unique to infrastructure that are very interesting. First is long-lived assets that are really critical to just the basic functioning of the economy. So they're tangible, they're hard assets. There's a very low elasticity of demand. By that I mean, people need it and they're going to use it even if the prices go up. All right? So they're price insensitive. They're very difficult to replace. There's significant barriers to entry. You can only have so many freeways. You only need one airport. There's this very sustainable cash flow. It's very steady. There's contractual agreements. There might be regulatory requirements and very long-term contracts. So think about the notion, what really started the appeal of this is something with a very long-term cash flow that if it's sensitive, it could be sensitive to inflation because if the inflation goes up, the price of using it goes up and you get to collect this over a very long period of time. Very steady. And you can use a lot of leverage on these, which is what gets employed to bring the return up. So those are sort of the key characteristics of infrastructure. Some of the arguments in the background are that we have under-invested in infrastructure in this country. And it's a political topic that's run across the spectrum and around all the geographies. So there's a lot of promise that this public-private partnership may take off. It hasn't quite yet. The leaders in infrastructure investment have come from Australia, where it's been quite successful there thus far. There's two ways to get into infrastructure on page 28. Listed infrastructure is just a fancy word for stocks. So you're buying stocks in infrastructure-oriented companies. They can be structured like a REIT. They can also just be companies that are invested in infrastructure. Then there's what we call unlisted infrastructure investments, which is private. We're focusing probably more on the unlisted side here because we think that has very great appeal. There can be leverage involved. They're typically like, it's a private investment. So it's like private equity or even private real estate in that regard. It's a making private investments, you're a limited partner. Strengths, the cash flows are very durable. You have contracts, you have hard assets backing them up. They may even be monopolistic, if you will. So you're getting this steady flow. The weaknesses is that, you need large asset sizes and there are long holding periods. So you need to share with others in the investment. You can't go build your own highway typically. And then, how do you benchmark it? That can be a real challenge. What are you going to measure it against? Typically, it's a cash plus or sort of an absolute return to a benchmark. There's some data on the listed infrastructure on page 29. Again, my interest would be more in the unlisted infrastructure for your purposes. To me, listed infrastructure can have some appeal, but it's like REITs. It could be a complement to a real estate portfolio, but I wouldn't focus on it. It's stocks. You have a lot of stock exposure as it is now. Page 30 gives you a flavor for what unlisted infrastructure can offer. There's really a range of types. You can be very conservative, which is debt-oriented. So you're lending to infrastructure operations. You can be in the middle, which is more core plus. So they're listed across the bottom here. Debt, you're lending. Brownfield means it's something that's existing. You go and buy it and you operate it. And then greenfield on the far right means developing. So new infrastructure. Okay. Unlisted infrastructure you can get at a couple of different ways. The ways to think about it, one is a closed-end partnership that has a finite date. So this is on page 31. You're a member of a group of investors, and it's operated in a certain way, but there is an exit strategy at the end of the day. Open-end, the majority of infrastructure funds till now have been closed-end. And the challenge with that, like private equity in general, is that the fund gets operated in a certain way, but there has to be an exit. People want their money back. So the time horizon may be long, but it's not that long. The open-end funds, which are now developing, which are finding much more appealing, you're going to operate much more in a buy and hold, and we're going to try to capture this essence of infrastructure. So we're finding this to be very appealing. The fees are a little bit lower. They're not particularly liquid. They're only as liquid as they can find someone to replace you, so you still have to think about them as very, very private. But to us, this really holds to me, it holds the key to really getting at this essence of the appeal of infrastructure. This long-lived asset you'll hang on to, and you'll get this steady return that could have some inflation protection built into it. Okay.
So looking at risk rate of return, seeing 8 to 12% on things that are publicly, the bridges that people are paying tolls on, that would seem like it would have a cap rate in the 4 or 5% range. Why the premium? What's the risk factor that's driving the premium?
On these particular investments?
Mm-hmm.
The operational risk is a lot different than real estate. There could be.
Real estate is.
Well, it's a different beast entirely. It's a different kind of business, and it's much more much broader in terms of what could go in there, but it's also more narrow. It's specifically a bridge, for instance. Mm-hmm. And to me, they're quite a bit different than what a closed or an open-end real estate fund focused on, just buildings.
It seems like to be a lot more risky because you have tenants come and tenants go. I mean, real estate investments are really about the tenant. The building is just a machine, it's the motor in the car. Mm-hmm. But anyway, I don't quite understand why the difference in cap rate on
You're talking about on page 29?
these. Yeah, on page 31.
31, oh,
Say a typical target returns is about 10 to 12%.
Mhm.
So it's just, I'm just,
There's a,
that's great. I mean, how do I get 10 or 12% on the Golden Gate Bridge? I mean,
right. But now, understand, target returns, this is what the managers and the strategies are promising. Right?
But there's also leverage involved in this.
Yes. Well, there's leverage in real estate too. but-
Okay, as a result of leverage.
Yeah.
So that would, you know, that's a component of it. If your income is greater than your debt cost, then that's accretive to you. But then there are also things beyond the Golden Gate Bridge. Now, naturally, no one is going to buy the Golden Gate Bridge unless they think they can get 8%.
Right.
Like, why would you, if the Golden Gate Bridge yields 2%, no one's going to buy it. If the city of San Francisco or the Golden Gate Transit Authority is so desperate to get rid of it, they would sell it at a price where it's worth their while.
Right.
Someone's worth their while to buy it.
Right. I mean, if you're buying apartment buildings at a 5 cap, you'd certainly buy the Golden Gate Bridge at a 3.5 to 4 cap. I mean, it's a bond.
Right.
Yeah.
You've got a captive tenancy there.
That's right.
Well, right, and then you typically lever it, and then that's where you're starting to look at a much bigger
Yeah.
return.
Yeah.
And also, there is a focus when you talk about infrastructure. It's easy to think of something iconic, like the Golden Gate Bridge. But most of it is not iconic, and in fact, it's quite mundane. It's pipelines, right? You know, it's cell phone towers. You know, those are a little harder to get excited. Oh, look, we own those towers over there. But they are these steady income streams, and the leverage can bring up the return. But they do have, they're fraught with, there's some operational risk, there's a lot of regulatory variability involved, and then it's just, they're quite a bit different than running a real estate.
So Jay, just to be clear, the notion behind this is that it would be a commingled fund.
Yes.
And we'd give it to a manager or managers, and then they would go out and find 2, 3, 5, 10, 20, 30, whatever it is.
That's right.
Different hard assets.
Yep.
In a range of industries then in different locales.
That's right. Okay. That's right. The fundraising is on page 32. You know, it's really come from nowhere in about 15 years. So the number of funds is the light green, and the aggregate capital raised is the dark green. It's still relatively small compared to all the other asset classes you're in. But it's growing, and we believe it's going to be a consistent part of the future opportunity set.
Okay, James.
Jay,
Yes.
one of my guiding maxims in the investment space is when you're making a decision and thinking about the tactical timing, either be early or be contrary. And looking at the dark green bars here on 32, it doesn't look like right now is either of those. It seems like there's a lot of money flowing into the infrastructure space relative to where it's been. Is now really a good time to be thinking about infrastructure, or is it still early, you think?
I think it's early. My belief is that it's early because the opportunity set really hasn't gelled yet. It's getting there. But I mean, there's the supply is what we're looking for. Clearly, the supply of products, or projects, if you will. People would love to be more invested in infrastructure. We haven't quite figured it out because there's a public element to it.
In the U.S.
In the U.S. in particular, and maybe perhaps some resistance. But given that we've identified this as a country as a serious need for a lot more infrastructure investment, and it hasn't happened yet, this is a case of positioning to be there in case it does take off, in my opinion. So I think it's very early.
Okay.
Yes, sir.
So in a case in California where there's new funding, billions, I don't know how many billions a year, but with SB1, new water bonds and so forth, is that just a little blip? Is that something that will happen? And so the question to me is, how do you get on board and know that money's going to get spent quickly? I mean, my own agency has spent 5 times as much money in the last year as we have in the last 10 because of these things. Is this part of that? I guess would be the simplest question.
It is and it isn't. I mean, when you're talking about your agency or your locality, municipality is actually going out and spending money.
Well, there's new money. I mean, it's like all of a sudden there's more road projects everywhere in the state of California. From put a little tar down to build a whole new system.
Right. And this would be trying to add to that. And in particular, trying to identify parts of the needed infrastructure that's not being met.
So in your situation, it's the state of California giving money to build something owned by the state of California.
No, owned by 500 cities and
Yeah.
52 counties.
Yeah, right.
And the state itself.
Yeah, right. But it's all owned by the public, if you will. I guess that's the
Right,
way-
unless they have something on the books for toll fees or something. But
Right. So this would be a case of the infrastructure would be owned privately.
got it. But would that be a case where you would, it's kind of removed, but you invest in construction companies?
That would be a different tactic than what we're talking about here.
So let me ask you something. So I need to build a water plant for Fort Bragg. And so I go out to the bond market and I borrow the money on the bond market.
Sure.
So why would I go to the basically private equity market? Is it because the bond market says, no, we're not gonna loan you 100% to build this water plant because there's some inherent risk with it. We'll only loan you, say, 80% of the cost of that. So the city says, gee, we better find somebody to buy this water plant for us, and then they go borrow from the bond guy. So actually, then in essence, are we asked to be equity partners in projects which the bond market will not fully fund?
That's part of
because
it.
Inherent risk.
That's part of it. I mean, it may be that the city has decided they don't want to load up more on bonds because they're all paid back by taxpayers. So in this case, you go to the private market, they build it, they get a long-term concession to run it, and they're regulated. I mean, think of a public utility, think of a privately owned utility, PG&E.
Well, I can see how it affects the city's balance sheet.
Can you go back to page 30 and give us a real world example of each one of those 5 opportunities you've got listed there?
Sure. Let's see if I can do this carefully here. On the debt side, it'd be a case of
So one thing, these are all types of funds in which you would invest,
Okay.
not individual
Right.
properties.
yes, right.
But they have a focus.
Yeah, and so they'll buy certain types of property.
Right.
So you invest in real estate now, and you have 2 core open-ended real estate funds. They're in that green box. Okay, so they're funds that go out and literally have 100 different real estate properties in their fund. So on this chart, we're saying, okay, in infrastructure, you can do the same thing. Where you invest in a fund, which will then go out, and admittedly, they're fewer than 100, there'll be 30 investments that they might have. But they're bigger and bulkier investments. So in the core area, it's, they're targeting returns that are, here we say 5 to 7%. They would be less levered underlying investments and very established investments, if you will. So a pipeline that's already up and running, right? I own that. I'm not levering a lot. I'm just clipping the coupon off of it. If you go over to the far end, opportunistic, that'll be something that hasn't been built yet. I think they want to have a pipeline here. And I'm going to raise a bunch of money and I'm going to build a pipeline and hope it comes, right? So there's more risk involved in it.
So is there different, you use pipeline as an example. Is there a particular bent of any of these? Is it a type of infrastructure they're targeting? Or is the opportunistic goes, so they might need a bridge there, they might need a toll road there, they might need a pipeline there? Or do they focus on types of infrastructure?
Some of the managers might have more of a focus. Some are very global, so it's not just U.S. infrastructure. and then some are to try to focus a little bit more on the US. So if you decide to move forward with infrastructure, or if you're just interested in learning more, the next step in the process for us would be, okay, Callan, show me some actual funds. I got the theory about what infrastructure is.
Right.
Just show me something a little more tangential now. Where would I put my money? What funds would we actually consider? And then what we could do is we could come back and say, hey, here are 4 funds out there. You want something a little more tangential? You want to really know, okay, where would we be putting our money? What are the underlying investments? We would bring back a report to you to see that.
Do any of those investors focus on, say, cell towers and wireless internet? Because that seems like an area that seems relatively stable.
They do. And if you go back to 26, I'll give you a little more color to both these questions. The initial focus of the Australians as they developed this asset class was on transportation. So they helped fund, they bought the Sydney airport. Then they bought a waste treatment plant in Tasmania. So these were big, tangible things. And then they thought, now we can expand where we're going to go from here. So those would have fallen, going back to your other question on page 30, they would have fallen into the core plus range. They're existing facilities and they're going to run them and maybe enhance them a little bit. Okay? What's developed since then is that, there's not a lot of airports that seem to be coming available. There's been a handful of toll roads built privately, so that would fall into the transportation category. Instead, the research is filtered out into the exact areas you're talking about: water, communications, and energy. So they're a little less identified. You can't point; they're harder to point to as you drive by. They're a little more embedded deep in the infrastructure of the operation of the economy, and they also fill in that whole range of what's already there. Can we take it over? What can we add to? And then really the difference between value add and opportunistic, when you go back over here too, or between core and value add is, value add to me means you're buying something that's a little riskier, maybe perhaps not as proven, maybe it needs a lot of work. Maybe it's not as far as building something new, but it's fixing something that's maybe not working.
Get rid of the old tenants, renovate it,
right? Exactly.
Typical value add.
Right.
Project.
Right. So I mean, it's an interesting, fast-moving space. We have a group dedicated to looking at this stuff, and I do have it listed down here. But you go back to this, number of funds raised. These are almost all closed-end funds. The open-end fund category is new and developing. There's now 3 managers we're aware of and we like, and there's another big fund that's opening up forthcoming. So we think it's worthy of consideration. And your fund of your size is kind of in the sweet spot. Just in the interest of time, taking a look at some of the returns and risks on page 34. You're trying to compare the publicly listed infrastructure. Looks a lot like stock. Timber is the lime green circle. Farmland's had a better return over the last 15 years, but it's a very small sample set, so I'd be cautious of looking at that one. And you can compare it to what real estate has been with the Maycreef Odyssey. But as you go sort of summarizing on page 35, as we look through all these, to us, infrastructure offers the greatest appeal to your portfolio. Not necessarily a recommendation, but as you go sifting through these, you have a lot of public exposure now. So our interest is diversifying real estate, diversifying the total portfolio. Looking at through that lens and not wanting to drag any of the return down, we think infrastructure is something to consider.
Would it not in this category include investing in limited partnerships? Somebody comes to town and says, gee, we want to build 100 units for the college dormitories. Great demand, college needs it, or they need faculty housing that they're going to rent forever. And the developer is standing ready to develop the project for the college, and we provide the capital for it and take a limited partner position. And wouldn't that fall into this kind of category? Be it whether it's to the college or whether it's just a market rate apartment building, but it's in our market, or it's in a market that we know, we're comfortable about. Developer who has a long track record, is fully vetted, kind of a qualified, qualified manager. Wouldn't that fall into these categories as good as directing investment in the community?
Well, it's a targeted investment. We're going to run into the question that James brought up about, concentrating the portfolio. And then I would also think of that as more in the real estate part of your portfolio. So I guess it is part of the real assets, you're right. But that would be a very specific investment outside of the two experts you've already hired to manage your real estate on your behalf.
Well, we don't really have experts that we've hired to manage our real estate per se. We've got investments in REITs, right?
No, you have two private investment funds.
Okay. What's the difference between them and REITs?
Well,
Our funds are their real estate fund.
the real estate funds, they're only valued at quarter end. They're not traded on a daily basis.
The diversified collection of buildings across geography and across building type managed by, in a partnership arrangement.
Right.
Right, a REIT is a publicly traded stock.
I think one of the points that he's making, if you look at the news blast from CalPERS, is it counted the percentage of California investments they made. And I think he's looking at what our local investments are. One of the things that popped up is that, to me, all this is very interested in the infrastructure and in tech and ag. But, and I guess this is the next presentation of the next meeting or whenever, this whole benchmark thing. We do so much that we go, look, we did better than that. But everything in this says benchmarking is weird for these.
It is.
So how will we create that thing to point at and say, see, we did good? I mean, that's to me, one of the biggest questions for the political pressures that we feel in this community.
So with these investments, the answer should be, ask me in 3 to 5 years, and I expect it to beat inflation plus 4%. And if I don't, then I did a bad job. Because I really don't have anything better to tell you on a quarter-to-quarter basis, did this work out well or not? One thing about benchmarking is, did this fund that I pick do better than other funds? And that's the question you're really trying to answer there. Did I do a good job picking the fund versus another fund? What I think is more important is, did adding this asset class benefit the plan? And that gets lost in a lot of benchmarking exercises, right? As you as a board, you don't want people saying, did you pick the best funds out there? Because that's this much of the return versus this much of the return, which is, am I in the right asset classes and the right amount in each asset class, and what's my total return? So for that benchmarking, I wouldn't get caught up on that noise so much as to say, okay, I want to make, what's your expected return now?
7.
7. I want to make 7. Have I done it? And over the last 5 years, you made 8.5. So yeah, you've met your objective. And then I would try not to get caught up as much of has this board done a great job picking one fund versus another fund.
So in one of your reports to us, 3 years down the line, we would see a benchmark, we would see inflation plus 4% go.
Yeah, infrastructure did what I wanted it to do, or infrastructure was a dog, and that was a mistake. Now, or I could use my capital better differently. So that comes to sizing. We wouldn't recommend you put a whole lot of assets in something that's that hard to measure, right? You're still going to have 96% of your money in something that's much tightly benchmarked. So if we flip ahead to page 41, we kind of came up with 2 different scenarios for you to consider. If you added infrastructure, we think you should add 4 to 5%. How do we come up with that number? Well, if you have much less than that, why bother doing it? If you have 2%, why bother doing it? 4 to 5% is a more meaningful allocation for the plan. If you had 4%, one way you could do it is reduce your private real estate allocation to 7, and then you stay at 11% for your total real estate target, or your total real asset target, which you have today. What we think that makes more sense is to just expand the real asset target to 15%, and then have a 5% target to infrastructure or some other asset category. So we wouldn't say put 20% in here and it's hard to benchmark. Right? We'd say put 5% in here, consider it a long-term investment, recognize it's a lower, less liquid asset class, and then keep it in there. So one thing you might ask, okay, so Callan, you did this asset allocation study and you've told us that your target return is 6.4 and risk is 13.9. If you did this, would it change my risk and return? And if you add 5%, the answer is no. You would have materially the same return and risk expectations. Part of that is because it's only 5% of the portfolio. The other part is that infrastructure happens to have a similar risk and return profile to your overall portfolio. So you're taking a little bit out of your other assets, putting it in here. The thing you're taking it out of in combination has a similar risk return profile as infrastructure. And that goes back to what Jay was talking about do no harm. We like the idea of adding real assets, but we don't like adding them if it's going to pull down your return expectation, or adding them and it really jacks up your risk. If you added 10% in commodities, your return expectation would probably might go down a little bit and volatility would go up. We don't like that. If you added tips, your return expectation would go down. If you add these private real assets, the return expectations are pretty similar to your long-term target, and your long-term target asset allocation shouldn't change materially.
And the appeal would be, in my opinion, is it's really a differentiated return stream to what you have now. And that can be appealing over the long term.
Greg, I would, go ahead.
Well, since both these assets are really rent-based, you get an airport or a bridge or water system, whatever, somebody's got to pay for the rent on that, the use of it.
Yep.
Or on the other hand, you've got an investment real estate manager who owns a broad base of different kinds of apartments, and I don't know what they own. And so it gets down, and then, so those are both going to trade on cap rates. There's going to be the value of those. And cap rates are driven by a universe of things, including the quality of the income stream, the quality of the tenant. So comparing owning real estate, broad-based real estate, versus a broad portfolio of infrastructure, the only difference, it would seem to me, is the quality of the tenancy, the quality of the income stream. And so moving into the future where you don't know what's going to happen in the future with real estate, the quality of the income stream has its ups and downs, where the bridge or water system, they got to pay. So if I had to choose one or the other, I think I'd go with infrastructure.
And it's also going to respond differently to changes in the economy over time, so it will differentiate the return. Even though you're right, at the end of the day, the rents, they depend on cap rates, the quality of the asset. You can also, and just like real estate, the quality of the income stream, which goes down to the quality of the asset as well. So, and you can choose to be in a different place in either of those investments, right? But the focus is going to be on core. I mean, one of the ways we tried to make it sort of concrete on page 42 is, if you looked at the second alternative that Greg's talking about, move the real assets up to 15%, then you essentially have 5% each in the 2 real estate managers and 1 in the infrastructure manager. It's, you know, I know the round numbers, but it's, to me, it's a reasonable way to think about a diversifier that's also large enough to have meaning, but not so large that it's going to give you heartburn. Yes, sir.
But also, I'd like to see in the real estate segment, I'd like to see us have latitude in our plan to do direct investment. I mean, we can find a developer in this town, quality institutional quality manager who wants to build student housing in our community. I'd want to be able to have the option for us to take a look at that and make a direct investment to do that. And that's not to say that I am a proponent at all of us having to be part of a community bank or take risky investments just to, make us look good in the community. But I do think we can make some quality, opportunistic investments in our own community. Maybe not today, but I'd like to just see an availability within our business plan that if that does come available, we can strike at an opportunity.
Okay, great.
I wouldn't hold it to you, either one of you to it this morning, but it sounds like a discussion for later. But are you imagining that you take this 5 out of the existing equity portfolio, or some out of fixed income, or a little of both, or?
Yeah, if you compare on page 41 the target versus this mixed 2 that has the 15%, we've taken it out of equity.
And then
And a little bit out of real estate.
just a little bit out of it.
So 1% out of real estate and 4% out of equity.
Yeah, I had a question about that, and looking at it. Your rate of return for mix number 2 is lower than any of them. But there's gotta be about 1 million different ways you could have chosen what you adjusted. You adjusted broad equity down by 3% and global equities down by 1%. What if you switched that and you took global down by 3%, or you took real estate down by, fixed income down by whatever you need. There's got to be a dozen or many more scenarios that you could do there. How did you pick this particular one instead of, for example, dropping fixed income by the 4% that you need to get back to 100%? Follow what I'm saying?
The part of the guiding principle was I didn't want to change your risk posture that much.
Okay.
And to us, this infrastructure, this idea of the open-end infrastructure is primarily equity. So you're changing one type of equity investment for a private equity investment. So I funded it from public equity.
And at 22%, you don't have a lot of bonds.
Right.
So that's your anchor to the portfolio, and we were a little nervous about reducing that anchor even more.
Right. So if you took it out of fixed income, to answer your question, the return would be higher and the volatility would be higher as well.
So in your client list, how many folks have moved into this in the last 5 years? What's their general reaction to how it's performed?
I think we've done about 10 infrastructure searches, that's my understanding. And there's probably been, for some of the larger funds that do some of the work themselves, they've also moved into infrastructure as well. It's been incremental, so in the same way that we're not suggesting a sea change here, it's been adding a small amount and moving forward. For the very big funds, it's hard for them to move more than 1% at a time. Right? And in terms of what's been their satisfaction, I don't know that there's been enough time passed for them to really decide that we love it or not. To the extent they've had listed infrastructure, it's done well recently. So anything that's been publicly traded has gone along with the stock market.
So what you're throwing out there as an idea for us to consider is an open-ended infrastructure fund, and you said there are 3 of those that you like. Looking back at the strategies on page 30, where do those three operate in terms of core plus?
They're more in the core plus range.
Okay. And that's where you think we should be concentrating? And does that, that puts all of the proposed real asset bucket in that core plus comfort zone.
Yeah, I don't know that there's any commingled funds yet that move to the far right of that risk spectrum.
Okay.
Open-ended community.
Open, excuse me, yes, they're not all closed end.
Okay.
The ones that are very opportunistic.
Okay. If we're thinking about, should we be in that core plus because those are the only options? Or should we be thinking about moving farther out to the right with this bucket if we had the availability?
Within real estate, I think, I wouldn't do it in infrastructure.
Okay.
I would first put in kind of a core anchor to infrastructure. Within real estate, you already have that core anchor. I could see, if we looked at real estate alone, I could see you making the argument we could pare back on the core exposure and add some core plus value add, or just add value add exposure within real estate to try to seek a higher risk return profile. A number of plans had been doing that because cap rates are so low, valuations are high, how do I get the return? I don't know if right now is the time to be creeping out that risk spectrum.
Right.
But some other plans have done it because they feel the pressure to hit an expected rate of return.
We need a market downturn
Yeah, for
and
that.
execute. That's the time to move in.
That's right.
So with what Lee's talked about and a targeted investment of somebody, something you knew, would that be in the opportunistic category?
That would be a different. Well, yeah, probably. It probably would be. I don't know. I don't even know how to define that. It would depend on how levered the property is, and yeah. So I don't know. I don't know where it would be.
One last question. On page 32, you said where the open-ended strategies of gaining, so on, it says 10 million being appropriate for a fund the size of Mendocino, $10 million. But you're saying 4%, isn't that 20 million? Which would we be doing, 10 million or 20 million?
Oh, no, they're just saying, their minimum requirement was 10 million, so it's not a problem for a fund of your size. So certainly could go higher than that, but a lot of funds will have a minimum required investment, and we're talking about something that's looking more like 25 million.
So in that, on page 32, you're saying that minimum required allocation is appropriate. You're not saying 10 million isn't appropriate.
That's right.
Okay.
That's right. Sorry, that is confusing.
So the question to me is, do we want to further investigate this? And I think yes, for this sometimes voting board member.
If I may, Mr. Chairman, I would jump out there and say, the plan is to redo asset allocation early next year. Because it's been 3 years. I know it doesn't feel like it, but it has been 3 years since we redid the entire asset allocation. And I'm with Greg that start at the big picture and then work our way down. I think when we get to the real estate, do asset allocation and then get to the real estate probably immediately after that would be my thinking.
Or you could include infrastructure as a core building block in the asset liability study.
Yes.
Yeah, I'd like to know what we might be doing if we're looking at a reallocation, not looking at reallocation and then guessing what it would be. That way I'm be more comfortable with knowing, okay, here's a new piece. We've already decided we're kind of comfy with it. We'll put it in. That's research first, change second, not change first, research second.
So what we could do is we could come back and show you, because it's a new asset class for you, we could show you something a little more concrete. Okay, if you put this if you would put money to work in this category, what would a fund like this look like? What do the underlying investments look like? So we could do that as a step 2 part of education. And then when you do your asset liability study, you can decide, okay, do I want this as a building block or not?
That seems reasonable.
So again, the timing for that would be,
Due back in November.
November, yeah. So about 2 months, so.
November 7th.
Okay.
Early board meeting. Yeah.
November
It is.
7th, it is.
So, and if we can't get the research done by then we'll just come back in December and do it.
Good.
Okay?
or feel comfortable with that.
Yeah.
Okay.
Do you know if we were to sell our building, could we sell it with an option to buy it back? No, I'm serious, because there's a big chunk of depreciation sitting there in that building that's not getting used. I mean, I'd like to buy that building and then lease it to the county, break even, get the depreciation, and then sell it back to the county at some point later. I mean, it's not me, but I mean,
Yeah.
there's a way to utilize the tax benefits that we can't use, and we can benefit from that.
There's a big building across the street here about a block away that happened, but nobody bought it back. I'll show it to you.
So, if I may, Mr. Chairman, to that point, in that general vein is what I'm thinking potentially when I ask the question of what do we do with our building. We like the location, we like our offices, but there are some difficulties with us owning the building, both operationally and then some pain that we have to deal with in terms of costs legally that present some challenges. So my thinking in considering that is we can offload some operational effort and probably realize some savings on our rent by not owning the building ourselves.
Would you consider selling it and then renting the same space?
Absolutely.
And I think if you sold it with a reasonable strike price to buy it back, that could be a real good hedge for the plan. And if you work that into an original sale where a buyer says, I'm happy with this X rate of return over 10 years or 20 years, and you're going, well, the market goes beyond that, we've got a hedge to buy it back.
Right.
Okay, so we've got one more report from you before we'll take a break.
Yeah, so we have the quarterly performance report. And we were supposed to take 90 minutes, and we're already at 96.
It was a good conversation.
All right, great. So this will be a little more abbreviated than normal, I guess. So on your iPads, you should have the quarterly performance report. And flipping ahead to page 2 in that report, just a real quick snapshot. On the top here, we show returns for the broad capital markets for the quarter. And on the bottom here, we have it for the year. Big picture comments is through the quarter, the U.S. stock market continued its rally, up about 3.5%. Small cap stocks did even better, almost 8%. International stocks posted a negative return for U.S. investors, down about 1%. Important for you to know is about 4% of that is currency depreciation. So the U.S. dollar appreciated on average about 4% versus foreign currencies during the quarter. It did even more against emerging markets. Okay. Bonds let out a little steam in the quarter, down about 20 basis points. And that's because interest rates came up modestly, especially on the short end of the curve. During the quarter, the Federal Reserve increased interest rates twice. And we fully expect them to increase interest rates another couple times this year. And on average, most people think another 3 times next year. So the Fed funds rate currently stands at 1 3/4 to 2%. And so what's that, 5 more increases of quarter points? I have an economist next to me, Jay, what's the Fed funds rate going to be then? 3 1/4, 3.5% this time next year. The 10-year Treasury currently sits at 2.9%. So we have the prospect of increasing interest rates and potentially a flattening, if not inverted, yield curve over the next year. Inflation rates have been coming in at north of 2%. So we have no reason to believe the Federal Reserve won't do exactly what they've said they're going to do. The economy is strong. Second quarter GDP came in about 4%. So above most, actually it was kind of close to many expectations, but above what we had been experiencing. So again, no reason for the Federal Reserve not to continue to increase interest rates.
Right. What's your thinking about our trade war?
Well, I don't know. I have a lot of thinking about it. I don't know how much I want to share, but
Good thing she'd ask you about the Supreme Court.
The first is that it is potential to be inflationary. Goods and services, the price of goods and services imported would go up if these tariffs go through and are sustained. So one thing it strikes me that the market is doing is they don't believe it's going to go through and be sustained. Otherwise, some stocks should be going down in value. So to me, the market doesn't believe it yet. If it goes through and the market starts to believe a permanence of it, then it's generally not good for trade, which is not good for companies.
For the U.S., if I can jump in, the thing to keep remembering is that we are far less reliant on trade than pretty much every country in the world. Seriously. I mean, all the developed countries, aside from us, trade's a much bigger portion. The emerging countries, China, are really much bigger. So you have to remember, as we've talked about now, the ratcheting up of the next round of tariffs, the Chinese don't have much to retaliate with because the trade with us is not very big relative to who they trade with the rest of the world. I think the bigger impact is what Greg's talking about is on inflation. These are going to get more expensive quickly because they're made in China. So it's a kind of a warning shot to Apple, if you will.
And $1,100 unit, they can't suck it up.
Well, the profit margin may shrink.
Yeah.
It's only 38% profit margin.
Right.
Well, that's a great example of where, okay, if it's going to go through, some stocks should go down in value if there's a permanence to it. So if you look at the U.S. stock market quarter to date, I mentioned that it was up about 4 percentage points. If you strip out the FANGs, Facebook, Amazon, Apple, Netflix, Google, the U.S. stock market was actually down on a year-to-date basis through June. So the stock market rally has been concentrated in some large cap technology companies. If you take them out, there's been a battle between, some energy stocks did real well because oil did well, and then a bunch of other stocks didn't do well. So it hides a little bit of the picture about what's going on in the stock market. If you look at your managers, a lot of the growth managers did real well. Your small cap growth manager on a one-year basis is up about 40%. But your international managers have struggled. And part of that has to do with the concentration in the U.S. and the concentration within growth that's been doing so well.
If we're looking at infrastructure, which is the price of which is going to be cap rate driven, and we know that interest rates are going to go up over the next few months, would we be better off to wait a few months to buy that when that's already priced in?
Well, so if you decide to invest in infrastructure, you probably won't have money in the ground for 12 to 24 months. because you're gonna do your asset allocation study, we would do a search, you would interview people, you commit capital, they may not call it right away.
So now's a good time to start the process.
It's hard, with private markets, it's always hard to time that. You make the decision today, it's really you're investing 2 years from now. And we have no idea what that world is gonna look like.
Well, we do know interest rates are gonna go up, so.
Well, we think they will. We certainly will.
We're still targeting the intersection.
Yeah.
I've been projecting interest rates to go up for 10 years. That's what I was just about to say. I've been wrong for 9 of them.
I gave up predicting decades ago.
So I want to flip ahead to page 8 here. And here we look at your target asset allocation versus your actual allocation. Big picture here is you're within your ranges, but you're at the end of June, you're a couple points overweight U.S. equity and a couple points underweight fixed income. It's because the U.S. stock market's been going up and the bond market went down a little bit over the last year. So if you look at our August report, that gap is another percentage point. So probably a good time to rebalance, go back to target, take money away from the winners, put it into ones that have lagged. So good opportunity for you to do that. On the bottom of page 8, I thought this was interesting to look at. So these floating bars represent what other mid-sized public plans are invested in. So a couple takeaways here is that, and it's something we've talked about a lot, is that you have a higher equity allocation, domestic equity, international equity combined, than your peers. You have done really well because of that in the past. Now going forward, will it be the same case? Hard to argue that the U.S. stock market will continue to give that like it has. Other plans out there have invested in these other categories, whether it's international bonds or private equity or global bonds or real assets. So when Jay was talking about real assets here, excluding real estate, about 1 in 4 public fund peers of yours invest in it, and when they do, the average allocation is 5%. Okay, so a little bit of benchmarking for you there. On page 9, here you look at the assets over the quarter, and you started with 520 million and ended with 520 million. You had investment returns of $3.9 million, and then you had about $3.2 million leave to make benefit payments. Okay, so you were up in the quarter, but you had benefit payments equal to your returns for the quarter. While we're here, I'll just segue and give you 2 manager updates that you should know about. One is about InvestTech. So you hired InvestTech to be your emerging market equity manager a little over a year ago now. So InvestTech, about 3 days ago, announced that their asset management unit is going to go public. A percent of the company is going to become a public company. Their parent company, InvestTech, in Australia, owns them, and they're going to sell part of their subsidiary. We think this is likely to be a positive thing for the asset management team, because their asset management team then has equity on their own business. We think it's probably a good thing. A lot of the details haven't been announced yet, so I can't say definitively it's a good thing, like who has how much of what equity. So it's something we'll keep an eye on and keep you informed with. The other update is the Harbor International Fund. You have about $30 million or 6% of assets in the Harbor International Equity Fund. The way that fund works is there's this company called the Harbor Funds that goes out and hires a sub-advisor. Similar to Vanguard. Vanguard's Wellington Fund, they go out and they hire Wellington to manage it. And anytime Vanguard can fire Wellington and hire someone else. As the fund company, they retain that discretion. That actually happened with the Harbor International Fund. So Harbor International historically hired a company called Northern Cross. They sub-advised this fund for years and years and years, and we like Northern Cross, and they've been in your plan because of that. Harbor decided to replace Northern Cross with another company named Marathon. We happen to know and like Marathon too, and we've been following them for a long time, and we have a number of mutual clients with Marathon. The change from our perspective was abrupt. We didn't have a lot of signal that this was going to happen. And it's a little disappointing on the case of Harbor in that we were more patient with their sub-advisor than they were, because Northern Cross had underperformed for some time, but we said, okay, their style is in a way that we expect it to come back. What's different from us and Harbor is that for us, that's water under the bridge. We're waiting for their style to come back. Harbor has to sell product. And if their track record isn't good, they're having a hard time selling the product. I think that's what really drove them to make the sub-advisor change. So they added Marathon, and we like Marathon. We think Marathon does a good job. Similar style, not identical, but materially similar style. So at this point, we're not recommending a change because we like them, but it's something that we're going to be keeping a close eye on. And frankly, we're a little disappointed in the abruptness of the change. In your report, we included some statistics that show what your international equity composite looks like with and without Marathon, or with and without Northern Cross. And it doesn't materially change the characteristics of the portfolio, let alone the return on risk expectations of the portfolio. Okay, let's look at performance and flip ahead to page 11. So for the quarter, the total fund was up about 0.75 percentage point, a little bit behind the total fund benchmark on a net fee basis, which was up about 1 percentage point. The main contributor to the underperformance, which is modest for the quarter, was the international equity portfolio, and the bond managers underperformed their benchmark modestly. If you look at longer time periods over the last year, you're up, I said 8.5%, I misspoke, it's 9.5% over the last year. 5 years, it's 8.5%. So you're either at or slightly ahead of your benchmark, your total fund target over these longer time periods. The last year has been particularly strong. So why did the international equity composite underperform? Mondrian was your greatest laggard. So Mondrian is a international equity manager that has a value orientation, and they focus on dividend discounts. And that has not been a strategy that has been in favor of late. Another thing about Mondrian is they tend to protect in down markets really well. So their recent underperformance is disappointing, but we still like them and the role they play in your portfolio to give you protection when value does well and to give you protection in meaningful down equity markets. Let's flip ahead to page 19. And here we look at the performance of the total fund relative to peers and the index. So here in that chart in the middle, the green dot is you. The triangle is your benchmark. And then the floating bars are public fund. It's a public fund database. Big takeaways, your performance across all these time periods, excluding the last quarter, you're in the top third over the last 2 years, you're in the top 10%. So performance is looking pretty good. And it looks decent compared to your total fund benchmark. And recall, I was talking to you about your 2 decisions you make. Asset allocation is the big one, and then, okay, I try to scratch returns out relative to my total fund target. That's manager selection. Asset allocation is always the most important thing. And that's what's really driving your ranking relative to your peers. Now, the equity market giveth and taketh away, and it's been giving to you. I want to point out the bottom right-hand chart here. So this is a risk-return chart. And all those little blue dots are other public funds. And you can see there's a relationship of risk and return here. It's upward sloping to the right. You take on more risk, you have a higher return over the last 5 years. So you have a higher return. We know that. But here, this is the page where it really illustrates that you've experienced more volatility than other funds. Your median volatility, the median volatility for other plans is a little less than 5, and your volatility is around 6. Okay? And that is all to do with the public equity allocation. That's why Jay and I came here to think, okay, if you add something, adding something that brings diversification, not as tied to the public equity market, is a good thing for you to consider. So how does the volatility come out? Let's look at page 21. This is looking at your fiscal returns, fiscal year returns. So June 30 wrapped up your fiscal year. And so I've already mentioned you're up 9.5%, your target was 8.5%, you ranked in the 20th percentile, 19th percentile over that fiscal year. Fiscal year 17, you had a great year, you're in the 3rd percentile, and you handily outperformed your target. I mentioned risk. Risk showed itself in 2016. Because of your heavy equity allocation and international equity allocation, and managers who underperformed in 2016, you were in the 94th percentile, and you underperformed your target meaningfully. Okay? So we look really good now, but we know that we're taking on a certain type of risk that's different than some of your peers. So just wanted to illustrate that. I could go in and talk to you about the individual managers or asset classes, but I know we're about 30 minutes over schedule here, so I'll look to your direction as to what you want to cover if you have individual questions.
So Investec on this chart, we bought in, so far nothing, pretty negative.
Mustang is,
I thought it was around 7 with a negative.
so okay. So Investec is emerging market equity manager, right? So they invest in stocks in places like China and Turkey and Argentina and Brazil, places with a certain amount of risk. Over the last quarter end of June, they were down 6.6%. The market was down about 8%. So I'm looking at this saying they did a great job. They only lost you 6.6%.
Okay.
But, okay, look over the last year, and you've had them for a year now. They're actually up 9% for the year. And the index is up 8.2% for the year. So the last quarter was brutal for emerging markets. And through August, it continues to not be friendly for emerging markets. It's down 3% in the month of August. So we know this is a volatile asset class. So it's going to be up and down, but year to date, they're still looking okay. Or in the year that you've had them, they've done a good job and they've actually produced meaningfully positive returns for you. Why do we have that dedicated allocation to emerging markets? It's because if you didn't, you would be always underweight emerging markets because your other managers you have are, so a couple of them are benchmarked to developed markets only. And if you don't have that dedicated EM, you would be underweight. If you look at your international equity composite, you have 25% in emerging market equities, and that's spot on what the index has.
To your point, Richard, about Investec, I will say, when Stan and I were in Callan's office meeting with a number of our managers, Investec was one of the ones that we talked with, and they had recently had an issue with a particular position they had purchased. It was a completely outside the norm event happened, and trading in the position was halted, and it was the kind of thing that you just can't see coming. And they walked us through exactly their thinking in the process, and they had a sound evaluation process. Seemed like it was a good decision. They just got a bad result with that name, and they were working through that very carefully. I have a great deal of comfort with them over time. When the emerging markets are down like this, they're not going to be able to be positive. So, but I do believe they will add value over their benchmark over time.
So overall performance is looking pretty strong. We don't have any recommended changes at this time. We'll keep an eye on Investec and the Harbor Fund going forward.
Good.
Is that it?
Yep.
Awesome. Thanks for your time. All right, to see you. Yeah.
Thank you.
very much.
Thanks, Greg.
Okay, so we'll take a break and return a little later.
Complain about our chair.
12:31, we're going to resume the board meeting, and we're going to go to item number 5, which is discussion of possible action regarding resolution 2018-1, defining compensation for all persons pursuant to Guard Code. And Jake, you want to please join us?
Thank you, Mr. Chairman. Trustees, you have a memo explaining the changes and the resolution, the draft resolution attached in markup. I'd be happy to answer any questions you may have.
So,
Mr. Chair, I move to adopt resolution 2018-01 as presented.
Second?
and this pertains to a small number of court employees.
Correct.
Okay, so we got a motion. All those in favor?
Aye.
Anyone opposed? Next time.
Agenda item number 6 is adoption of resolution 2018-02. Trustees, you have the memo and the draft resolution. I will point out that in the draft resolution, the pay codes 330 and 331 have been added, but they're not highlighted in markup language. My apologies for that oversight. I'd be happy to answer any questions you have.
I move to adopt this resolution as presented.
Second.
I didn't read it exactly the way it changed.
And essentially mirrors the action on the other items.
Yes.
Okay, all those in favor?
Aye.
Anyone opposed? All right, now we're on to item number 7.
Thank you, Mr. Chairman. Trustees, as is discussed in the memo and the attached, no, there's not a memo. As discussed in the review of the appropriate region for the cost of living adjustments, the recommendation is that the board retain the western region consumer price index for granting cost of living adjustments, and that the issue be revisited in 2023. I'd be happy to answer any questions.
I had a couple of thoughts on this, if I could. One, thank you very much for all the work and research on that and for your findings there. What I was going to pitch is just a different recommendation, acknowledging the same finding, but that I guess what I noted is that the difference between the West region and the Pacific, our new actual assigned area, is pretty negligible. It seemed pretty small from what I saw. Is that I would propose that we adopt the Pacific instead. That would be, it would be in light of a few different factors that aren't noted in here. I was thinking about the fair market rent issue, and that was used, but we looked at the period through 2017. 2018 and 2019 seemed to show a much higher trend of an increase in Mendocino versus the Bay Area, which I think would jive with a lot of what we've seen around here, that rents are increasing. What I also noted is that we considered shelter to be the biggest factor, and everything indicates that it does appear to be. But because they are so close, it doesn't seem, to me, it just doesn't make sense to adopt the West to go above our region. When it's that similar, it seems like a more radical approach. In the past, we considered either using the local metro area or our actual region. Now, even though they're similar, we're suggesting they go above our area to a higher level index. So I just felt like Pacific might present an option where we're shooting the gap in between the Bay Area and the West, and that we may be able to put this issue to rest better in the future instead of every 5 years coming around to this. It might offer us a way to, maybe put this issue to rest for good. Those were my thoughts.
I just want to say that I agree with you.
On that, okay, thank you.
Go ahead.
I'd like to hear James's response to why he chose the one that he did, the Western region.
So the analysis, we all know I'm a numbers person, and the analysis points to the Western region being the better fit based on the numbers that we have. And it is a backward-looking analysis, but there's no other analysis I can perform.
So did what Pat said about living costs and housing and all that, did that make sense if the numbers are really close? Did that make sense to you? Could you see it either way?
I understand the point. They are relatively close, but the Western region does appear to be a better fit for Mendocino County based on the data and the analysis, which is a repeat of what we did 2 years ago now. I stand by the analysis. I do look at, to the issue of, is shelter the most important component? I didn't repeat the analysis, how important shelter is. I felt that was very clearly established in the prior research, that shelter is the most significant component of the difference between the various CPIs. And that's why the prior research had focused on just the fair market rent or the Zillow housing value index, and here we just use the FMR. The analysis indicates that of the 4 possible regions, the Western region is the best fit, based on all 4 measures, 3 measures we used. The correlation, the average annual growth rates, and the elasticity estimates all indicate that the Western region is the best fit, although the Pacific subregion is just a little bit behind the Western region. It is still behind in terms of being the best fit based on the historical data and the analysis that we conducted. So.
I wasn't here when you did the previous study. I was very impressed and reading through and trying to remember R squared, standard air and all of that, so thank you very much.
Happy to do it.
Oh, go ahead, Jerry.
I'm a biologist, I'm a scientist. I try to make my decisions based on the data that's available, and this is the data that's available. So I'm looking at the western as being closest.
So the question is, the growth rate you have here is 98 to 2017. What was the end date of the data you used? June 17?
So, the fair market rents data is an annual number. And that is all that's produced as an annual number. And I'm trying to recall back to how that's produced. I know it is, if memory serves, and we all know how dangerous that is for me to say, if memory serves, it is a number that's released at the end of the year by the U.S. Department of Labor, the Housing and Urban Development Office. I want to say it's at the end of the year, but I'm not absolutely certain. But it's not something they produce monthly, and I picked an end of the year number. They produce an annual number for that, and that's what we used.
So yesterday, before I left the office, I was dealing with a CPI rate increase for solid waste, and so I was looking at these different models, and there's information available as of June 30th, 2018 right now. I didn't look at the housing cost as an individual thing, but as a portion of it all, there was a significant change that went on since 2017, and specifically in our own region, Sonoma County, Mendocino County, where property values have increased 20 to 25% based on what's happened climate-wise, fire-wise, and so forth during that period. And, knowing, and I think this was part of the argument, so when we did this the first time, is the western region to the degree is a big region, and it's based on an amount of population that they jam into this for calculations. But we're in a very unique place here. If you go to the political realm, we're the only rural area district in California that has a democratic representation. All of the rural assembly districts, senate districts are Republican. We are not the same kind of ag, we are not the same kind of rural, and we may not be the Bay Area, which that for 3 years topped out at 10.1, and the western region is 7.7 during that same period of time, that I believe that the Pacific subregion would be a closer fit based on what's gone on in the last year. To put it all the way out to 2023, I would just as soon take into account the information that the science that's available today up till 2018 June would be better incorporated into this. And I think Patrick's Pacific subregion would tell out to be our best fit.
I was going to point something out just about when the feds release the fair market rent data. It's in the summer of each year. So that's how I pulled the 2018 and 2019 data, which is what was showing that 10% swing differential between the Bay Area and Mendocino County. I didn't pull numbers for the rest because that's way beyond my ability to do, but that's where I grabbed it. And I think what caught my eye is that when I looked at CPI stuff, everything else in California seems to be more expensive. So that's where I was coming from, is I'm not disputing the final answer that you had. I'm just saying if they're that close, and then as far as I can tell, we'd be the first county to ever interpret that statute as going above our area. And maybe Jeff could answer that, I'm not sure. To your knowledge, has anyone else done that?
I'm not sure, but the framework that you're working in, given the language in the statute, there's no cases that interpret it. So you fall back to Prop 162, the California Constitution, which gives you plenary authority, broadly that means it's broadly construed and you have a lot of flexibility. And the ultimate test is whether your decision is arbitrary and capricious. And so it's just like when you're following your financial expert. In this case, the expert happens to be our administrator, who's also got a PhD in economics. So if you're not going to go in that direction, you got to have a really strong reason why. So that's the general framework that I think you're working in with this issue.
For clarification, I guess I'm not clear, see if it was me. I thought I understood that at least one of the other 37X has gone with the Western region.
Believe that is the case, but I cannot recall which 37 Act plan that is. I can't recall if it's Fresno or Imperial or someone else, but I seem to recall, again, my faulty memory, that one other plan is using the Western region, but I don't know what that plan is doing with the redefinition of geographies at this point.
Okay, Tim.
I just real quickly fall back on what our actuaries told us for probably 20 plus years. Different actuaries at different times is you pick one and you stick with it. So I thought going away from the Bay Area CPI with San Francisco. I agree that at this point, since we did pick another one, we should stick with it for at least 5 years. I think that would go along with the actuaries. But follow-up question, in the 5 years, will we be looking at the, whatever they call it, the coastal area of the Western Regional as opposed to the more inland? Would that be a decision that we would be making in the end of 5 years, in 2013, or 23, I'm sorry?
So, if I may, Mr. Chair, at this point in time, and it's hard to know what could happen in 5 years, but at this point in time, there are 4 options that are available reasonably to the board. My vision of what the analysis would be in 2023 is looking at those 4 regions again and seeing which is the best fit at that time. Again, it's on a historical basis, but which is the best fit from there? Who knows what could happen? There could be new regions added or something subtracted that we're not even able to envision at this point. But thinking about it 5 years from now would be, what's the choice set? Do the analysis for all of those choice sets from that point.
And the 4 are what?
So it's the Bay Area, the California, the Pacific subregion, and the Western region. Those are the 4 that we consider here. Those are the 4 that I'm aware of that we can make a reasonable argument to use as the basis for our cost of living adjustment.
Getting back to the California, I see the language that the CCPI is not based on, or not calculated by the Bureau of Labor Statistics, but it's calculated based on the information from them. And the government code is clear, it says it shall be calculated by the Bureau of Labor Statistics. I go way, way back to prior county councils who say you take the government code as it comes, you read every word, you don't delete any words, you don't change any words. If it says it has to be based on, or it has to be calculated by the Bureau of Labor Statistics, you can't say, well, it's calculated based on their information, therefore you can use it. I think there are some people who say you can't. If it's not calculated by the Bureau of Labor Statistics, you don't use it. I think between now and 2023 that should be looked into more. I don't know how much analysis went into that, but I think it's something we need to look at.
So legal counsel and I did discuss that before including it in the analysis, and I don't want to speak for Jeff, but I think it falls within the board's plenary authority to decide if that is the best fit. then we can use that, but I'll let Jeff speak to that issue.
Well, I think that's accurate, and, you want to take it as closely as written as possible in which the county seat is situated, and so we're in an unfortunate situation where, like a few other counties, and I think I remember as well that one has selected the western region. I can't remember if it was Superior or the other, Fresno. But I think this is a reasonable interpretation and consistent with the intent. There's no cases, and so you do fall back to Prop 162. And
Well, I'm talking about the California CPI, which again it's not calculated by.
yeah, it's one step removed.
So I think we need to look into that before we make a decision in 3 years.
So the one thing I was gonna point out, it is Fresno and Imperial. I did double check that from last time. But the difference that I was pointing out with them is that they picked the West back when it was our local area for the county seat, like when we did before. But now that's no longer the case. Now the Pacific is our local area. So the point I was making earlier is that we will be the first county after this revision to not use the local and to go a level above. That's what I was getting at.
So the Pacific subregion is the 5 states, Washington, Oregon, California, Alaska, and Hawaii. Whereas the Western region takes those 5 and then adds 8 more states, Arizona, New Mexico, Colorado, Utah, Nevada, Wyoming, Idaho, and Montana. But again, I go back to the analysis showed the Western region to be the best fit. And I would caution the board that moving away from what the analysis shows is a slippery slope and something you should think carefully about before making that kind of decision.
Lee?
I move that we adopt recommendations. That's that.
Second?
Okay, any discussion? Okay, we'll do a roll call vote.
Mr. Sullivan?
No.
Ms. Cavnis?
No.
Mr. Parker?
Aye.
Mr. Knudsen?
No.
Ms. Harris?
Yes.
Mr. Shoemaker?
No.
Chair Drury?
Yes.
Ms. Smith?
And Ms. Smith? Yes. We've had so many leaving. Well, we have a tie.
I believe that's a 4-3 vote in favor of the motion.
Did
Well-
Richard and Tim both get to?
Yes, I get the vote on the new law.
Under,
Substitute for Craig.
No,
if 2 people are absent.
there have to be 2.
Sherry and
Correct.
Craig doesn't count.
There have to be 2 elected members absent.
Yes.
There's only 1.
Craig is a safety, he doesn't count on that.
He does.
Sherry-
Sherry is not elected by the membership.
So what's recount the counting?
So then it would be 4 yes and 3 no.
Well, there's 1, 2, 3, 4?
No.
No?
Mr. Shoemaker
Well, I
did
keep
not vote.
counting you.
Okay.
1, 2, 3, yeah.
So just to recap, the law is when 2 of the 3 elected representatives are absent, then the alternate votes. And Sherry is not elected by the members to be on this board.
My error.
Is that good?
That's correct.
That's right.
So the vote again is still 3 no and 4 yes.
And clarification, this does not change the region we're doing right now.
That's correct.
Okay.
So according to our bylaws, the motion carries because it's a majority of the members present.
Okay, great. Well, now we're on to item number 8, possible action regarding retiree return to covered employment policy.
Thank you, Mr. Chairman. Trustees, you have a proposed policy. This is a new policy document before you. We have language from a number of different areas speaking to this issue, and there's been some confusion regarding the issue. So what I attempted to do here by crafting this policy is draw from all those different sources and create one source document on the return to covered employment to give clearer guidance to both our retirees and to our plan sponsors as to what the rules are regarding a retiree returning to a covered employment position. I'd be happy to answer any questions.
It's just, it covers Pepper, right? It does not.
No, this covers all members.
I saw somewhere Pepper. I guess I misunderstood.
Just
It was enacted as part of Pepper, but it applies to anybody who retires and tries to come back to work. So in fact, it probably hasn't hit any Pepper people yet. Well, I don't think, but just because it's all the classic members who retire and come back to work, these are the requirements before they can do that.
My comment was just the last sentence of the policy. The policy history probably is missing a word that you might want to put in there before.
That's true, it was by the board.
Adopted will be inserted.
I just had a question. How do you guys, or staff, how does this proceed to impact people that are the extra help employees coming back to work right now with the county? Does that, and that practice in general, is that going to diminish that, or do we know what?
So the intent of this policy is not to change any of the existing rules. It is to just bring all of those rules together in a single location.
Okay.
So there are
Very
still
tedious task, I might add.
there are still the PEPA requirements of a 180-day break in service, unless the return to covered employment is approved by the governing authority of the plan sponsor in an open meeting, not on a consent agenda. There is still the requirement, even if that is the Board of Supervisors gives approval for someone to return to covered employment, if they are under the normal retirement age, they are still required to have a 60-day break in service by the IRS rules. And there are the limits in terms of the 960 hours of what they can do in those, in a return to covered employment in a fiscal year. So we had those in a bunch of different places, and this was just a codification in one single place. And also making it clear that this applies to individuals that return in an extra help or part-time capacity, as well as contracts.
Tim, yeah.
Yeah, I just, as I'm reading this, and I just think it's confusing more than maybe right or wrong, is for MCA ERA retirees to be eligible to return to covered employment. PEPRA requires that they retire 180-day break in service, so on and so on. And everything we have done so far, in fact, including 2 different resolutions we passed just about 15 minutes ago, we passed a different one for PEPRA and a different one for non-PEPRA. And now all of a sudden, we're including everybody because it's something that it's PEPRA that applies to people hired after January of 2013. We're applying that to everyone.
So James, my understanding is that parts of PEPRA did apply to all employees. Is this?
Pepper's just the name of the legislation.
It covers the people who were hired after 2013. It doesn't cover people who,
There's pieces of the legislation that apply to both, and this is one of those pieces.
okay, then why do we do two separate resolutions for pay time?
Because that's one area that is separated. If you look at the code section 7522.56, it starts out by saying this section shall apply to any person who. So, I mean, this is not there's no ambiguity here. I mean, this has been applied since the legislation kicked in, and it's been applying only to people who are classic employees. I don't even know if you could have, I guess, could you have retired and come back to work already as a prepper person? Hypothetically, yes.
Okay.
There's a possibility for that.
Okay. Well, reciprocity.
Yeah, I suppose, but this clearly applies to, intended to apply to both. Excuse me.
I just had one other question in here that I saw. So after the Board of Supervisors finds, the urgency exception or the emergency exception to allow a retiree to return straight back to work, and here we're saying MSERA will review the certification from the employer. Have we done that before? I was just wondering.
Yes.
We have?
Yes.
Okay. Have we ever rejected someone that the board found? Okay, I was just curious about that because I've never heard anything about it before.
We have had occasion where there's been the emergency exception, and we dialogued with the plan sponsor, and they provided us a letter clearly indicating that this applied in this case. We did review it, but we were fine with that. And I wrote the language that we would review it and have the ability to say, no, that doesn't apply, because that's an open door, and we don't want plan sponsors trying to walk a lot of people through an open door like that. For example, if a retired sheriff's deputy is working at the courthouse as a bailiff on a part-time basis, is that a disaster-related position? Absolutely not. And that's a question that we have asked. Could this be characterized as disaster-related? No. There's nothing about working at the courthouse as a bailiff that is disaster-related.
Okay.
So.
Any more questions about the policy? Is there a motion to approve?
I so moved.
I second.
As amended?
As amended, put the word adopted in there and I'll be happy.
Okay. All those in favor?
Aye.
Anyone opposed?
No.
Okay, now we're on to 9, which is possible action regarding amendments to Executive Director Charter.
Thank you, Mr. Chairman, trustees. You have the memo outlining my error in putting the charter amendments before you last month. This was brought to light as we were working with the auditors several weeks ago during their field work, and we're making the changes here. These changes, the additions to Section D of the policy were previously approved. This just adds them back in for clarification.
Any questions about the amendments? Make a motion?
I will move to adopt this.
Motion second. All those in favor?
Aye.
Any opposed? Okay, so now we're on to discussion possible action regarding MSERA Board Governance Evaluation.
Thank you, Mr. Chairman. Trustees, you'll recall that last month at our board meeting, we discussed the fiduciary, the FEQ, and for the life of me at this point, fiduciary equivalent quotient, something, evaluation quotient, I can't remember what FEQ was. But it was an evaluation that I had completed where we ranked very, very well. There was questions from the board about getting further information, more detailed. I reached out to the organization that conducted that survey, Fiduciary Governance Analytics, and they had two options we could pursue. One was to get the more detailed report from my responses to the survey, or the other was to do a broader analysis where everyone, all of the board and senior staff participate, and we get a much deeper dive into the analytics. I will remind you that we have on our work plan to do a board evaluation, and it is industry best practice to do that, and I see the governance self-assessment checklist as really a board evaluation tool. So I recommend that we pursue that and amend the budget accordingly.
Fiduciary effectiveness quotient.
Okay, there you go.
I told James I wouldn't ask any questions, but I have a question. I've been through lots of board evaluations, and I think it's crucial that we do a board evaluation. I think having each of the board members and senior staff respond to a survey is the way to do it. It's important to do that. My question, though, is based upon my experience, the value has been in having the board members respond and then talk about our difference in responses, not necessarily comparing it to the norm or other entities that have taken the same survey. So I question, I question the money invested in having this company give us the analytics about it. And I'm not against it, I just want to make sure that we're spending the money in a wise way that would be helpful to us.
Mr. Chairman, I appreciate that perspective, and I think that's very, very helpful to have someone in the room that's done board evaluations before. I will look into the sample evaluation.
The penitentiary.
This is Windsor State
Oh,
Pension.
State pension, I thought I said pen. Yeah, it's a pension. I had in my head it was some prison system.
I think it, to your point of the board discussion around the differences in grading, the first two columns there represent both the low and the high answer provided by all the respondents. I think that's a good means to facilitate that discussion. I don't know that we're going to find a more cost-effective means of conducting a board evaluation that's as detailed as this.
How many questions on it, do you know? I mean, how much time, I said 45 minutes per board.
Yes, that's the expectation, is 45 minutes to complete the survey. I don't know the number of questions, but you can see,
How much does it cost?
$2,500.
So, if we only did this in-house, how many hours do you think you would spend going through this thing to put it together for presentation at the board? If you did what GCAC were to do, how many hours? This will be a series of comments. 10, 25, 30?
I would, at minimum 10,
Okay.
but I can easily see it going well past that. And
To work on this or to start from? I'm just trying to understand your question.
Well, okay, if we took the GSAC model and we said, don't buy these guys, you scab it together yourself, you run it through us, and we come back and report. My point's gonna be, what's his hourly, fully loaded value that he would put into the product? I would suggest it's higher than $2,500.
And he would do more than required, because he'd have to do R squared and correlate.
That is so very true, and then he compared it to the guys in Connecticut. That's right.
I'll bet you in 3
But-
clicks, I can do a board evaluation out of Google. A standard board evaluation form off of Google in 3 clicks.
But then it would have to be analyzed and
Then,
evaluated.
yeah, it would be compiled and analyzed and report formed, and I guess my comment is, what would he be doing instead, and what would it cost him to do it? Cost us to have him do it, so I don't think the 2,500, the metric of spending 2,500 is, oh my God, but on the other hand, the visible metric of him doing it. Yeah.
Well, for clarification, this relates to other pension investment boards, right?
Yes.
So it's somewhat unique, it's not just generic.
Oh, that's
board
what I'm saying,
evaluation.
but we have to go out and call everybody else and get their copies as well, so we'd spend some time modeling the GCAC.
And it does seem like a lot of what we look at is how are we benchmarking ourselves versus other pension funds. And so to me, there seems to be value in our previous discussion about this, that we wanted to see how we relate to other pension boards. So I thought that was part of the reason why we were looking at this. Yeah.
So if I had a vote today, I'd support it.
Can you make a motion?
Leave.
Any more discussion? Does someone want to make a motion?
I move that we spend the $2,500 to adopt this board evaluation plan.
I'll second.
Any more discussion? All those in favor?
Aye.
Any opposed? Okay, thanks. Okay, and now we're on to quarterly budget update.
Thank you, Mr. Chairman. Trustees, you have the quarterly budget update, the end of the fiscal year 2018 budget that Stan has prepared. There's a number of discussion items presented. I tend to focus on the bottom line, and you can see that for fiscal 18, expenditures were up over the prior year in total by a significant amount, although a sizable portion of that is due to reclassifying manager fees. And there are changes. There's also increase in administrative and board expense, largely driven by personnel changes, increases in compensation. Legal expense was higher than the prior year. And then compared to, we came in below budget on both administrative expenses, and we were over budget in total expenses, again, driven by the manager fees. I'd be happy to ask Stan to answer any other specific, more detailed questions, because he knows these numbers much better than I.
Is this final, everything has been accrued?
Yeah. There might be little tiny reclassifications, but everything's been recorded.
Is there a motion, or we just?
This is just an update, advising the board of where we came in at the end of the year.
So the question on the disability numbers, the 2017 blank at hearing preparation. Why is
We had
that?
no hearings in fiscal 17.
So this really, all this is totally driven by outside forces.
Okay, so if there's no more questions, we'll go on to discussion regarding administrative report.
Thank you, Mr. Chairman. Trustees, you have the administrative report before you. Several items there. I did want to indicate to you that we've instituted a new process for the independent review of retirement benefits for related parties. It's just a best practice to make sure that we're doing everything, not only doing it right, but that there's not even the appearance of a potential conflict of interest. So we've instituted that process. Yes, ma'am.
Oh, go ahead.
I'm just curious if anybody else had to look up the definition of any of the words in the third bullet. Thank you, Richard.
We couldn't find them with the F word.
I found them, but I had to
A
look
fiddle?
up.
We figured it out.
Consent.
I work with the public guardian's office, and I confirmed, and I looked them up before. They didn't come from me, I'm just saying.
Oh, yeah, it was when you hire a PhD.
They could have said like blood or marriage or something.
When you
He's an economist with words.
I get paid by the syllable. So. Go ahead, Jay.
I have a question about a comment about the description of the bills. When it says that they're enrolled, that means that they're passing through without the governor's signature, or they're awaiting his signature, or...
Enrolled means it's gone to the governor for signature. It'll say chaptered, I believe, if he's signed it.
Yeah, that's what I thought. Chaptered means it's signed, so the governor can still veto some of these things. I know it's not time to really discuss this, but looking at least a couple of the bills that are dealing with not investing in Turkey, yada, yada. My opinion is that these are very dangerous things to be sending on and extremely harmful to pension funds, particularly in the long range, because it becomes extremely difficult to say no to one and not another. And it really is a very slippery slope that could tie the hands of the board and also of our investment teams.
Did those impact us, the legislation you're referring to, or is it just the major CalPERS and CalSTRS?
I believe at this point, so looking specifically at AB 1597, it is only directing CalPERS and CalSTRS. But it's a first step. And if enacted, it would not be surprising. I mean, my understanding is with California legislation in this general area, there's a start with CalPERS and CalSTRS and then progress to UC systems and the county plans and then everyone else. Happens on a fairly routine basis. So.
I'd add in that the city manager's department of the League of California Cities is taking positions in opposition of this type of legislation.
Good.
That impedes on their
That impedes on the possible investments.
Prop 162.
Yeah.
So the next item on the administrative, I'm going to jump back, is looking at the possibility of installing an emergency backup generator.
Yes.
We do not have any backup power ability currently. I was looking for some direction from the board, given the potential to spend between 20 and 30,000. Is that something the board's interested in us at least getting additional information, or just cross our fingers and hope it doesn't happen?
I think additional information is crucial, and one of my questions would be, obviously it will keep the electricity running, but what's the impact on the internet? I mean, I guess that's dependent upon other things in the area, not just our building.
Right.
That would be what I would be.
So the question I have in this is, the analysis of what and why we would need to keep power in the building. And if it was simply to operate a computer or 3 computers, or if it was to keep the lights on. And are those things necessary in an outage or an outage of a period of time? And I think, if there's some less expensive, if there's a $3,000 generator and everybody just has to unplug and replug in over here, if that's good enough. Or if this is a system that's totally wired into the building and it's an automatic turn on type of system, which I'm guessing it is. If we do really need that kind of backup. Hospitals, grocery stores, refrigerated food processors. Those guys really need that stuff. I don't know about us.
Jerry?
Checks to go out, people expecting to have money in their banking accounts.
Well, and I guess you take your flash drive, you go someplace else. I'm not sure. Again, to me, it's like, oh, can we unplug and plug into a $500 unit and then plug our printer into that? If that's all we need, but if we've got a room full of processors that won't work for, that's a different story.
I just know how difficult it was to get, Patrick, you probably will as well, to get orders to evacuate when you have no power. And I think I'd like to have more information. I believe that with climate change and with, I hate to use the new normals, but I think we need to be doing as many things as possible to allow our employees to work and to have our data be saved and have the lights on.
James?
So, to the question of how do we operate? One of the projects that I have been spending a fair amount of time over the past year working on is our business continuity plan. And a significant component of our business continuity plan is the ability to telework. All of our staff have the ability to telework. So the business continuity plan contemplates a number of different events where either the physical capital is impaired or the human capital is impaired. And whether that is a short-term or a long-term type of horizon that we envision. The primary backup plan envisioned in the business continuity plan is telework. And what I can tell you is with telework, we can do the majority of the work that we need to do on a regular basis. Especially the most critical operations. The thing we cannot do at this point with telework is print checks. We have no ability to print our own checks right now because that takes a specialized printer that's only in our office at this moment. As soon as we're on the verge of the board approved last month or the month before, engaging LRS for a service, PG Secure, where if we're not able to print checks, we can call LRS and say, print checks and get them out the door, and they will do that for us. So we are building out our capacity in a disaster, in a business continuity type scenario. I think when you're thinking about this, those types of scenarios, the more backups you have, the better. We anticipate, we want to be prepared for if we have power at our office building, but the county has no power, what are we going to do? And because at that point, if the county has no power at their building, we don't have internet at our building because it's all driven through the county administration center there. So we have anticipations of what we're gonna do there. But the more options we have, the better off we are. I think it's a good discussion to have, of, is this belt and suspenders and another belt? But I would recommend we at least get additional information. Spend a little bit of money to get that information, to find out exactly what we would need, what it would take. But I think it's worth it to at least consider the possibility at this point.
So a question for Patrick. Would this system back up the entire building, including the tenant, the state of California, that's over half of our building? And if so, would this be seen as basically an improvement to that building and either something we would pass on one way or another through the rent to our tenant? Or is it something that just makes it that much more likely that they're not going to be looking for another building at some point because here's yet another great service offered by Amsera?
I don't know that we would be able to renegotiate the lease based on this alone. But it's certainly something that if we decide we want to go down the road of adding this to our facility, we can certainly look into that, see what's available.
So it would in fact also serve them, it would serve the whole,
Yes.
any tenants of the building?
Yes, I believe it should. I don't know that you can bifurcate that way. I'm sure you can.
I was going to piggyback on some of what Richard was saying earlier. Just it'd be interesting to get some info about smaller generators. Because I know in the main county building, the integrated system doesn't power computers, printers, anything like that. It powers the main lights in the hallway, but there's not enough juice to run any of that. So I would just want to understand whether that system would be superior or if it would be similar to what the county admin building has. Because in that case, you would still need a smaller generator anyways to power a printer and a computer. And maybe we could just get away with that in the end as an emergency backup outlet. It's just, in my experience, the integrated system doesn't power very much where I work now.
That's shocking.
Yeah, you can't.
Why? Yeah, why? Why would you install an integrated backup system that doesn't have enough capacity to keep you running?
We were advised to limit our usage when it comes on. So we still kill the computers. We kill the lights in our office. It's just the main lighting that's on.
It's called initial investment. Yeah.
So I'm just curious to see what that price accomplishes compared to what we have now.
I'm going to assume we have room under the limits on how much we can budget for administration? Or would we look at this as an improvement to the building that wouldn't come out of our administration?
No, this is clearly capital expense that's not counted against the administrative. And we do have plenty of room in the administrative caps.
And when I built my house 12 years ago, I spent $5,000 on a generator. And it would run enough, it would run our office. Wouldn't we not have all the lights on and a coffee maker, but it would run all the computers and some lights. And in 12 years, I've used it twice. And it's a pain in the neck to maintain. And you have to change the fuel in it. So unless you get a gas one, a natural gas one, if it's a gasoline one, you have fuel issues, you have maintenance on it. If you have gasoline in it, you have to remove the gasoline every year. Where are you going to pump that out? In a government agency, you're not going to throw it out in the backyard. So, you've got real costly maintenance on this. And like I say, I've used it 2 times in 12 years. If I had it over to do again, I wouldn't bother with it. And so how many times has electricity been out of our building that it impacted, during work hours? And of those times, how many of those were on the first Monday of the month or whatever it is we send out the checks? And if it's out, it's only going to be out for a couple hours and back on the next day. And if it's some major emergency that we've been bombed by North Korea, you're not going to be worried about it anyway. So it's just, I don't want to waste $25,000 on something like that.
Murphy's Law, the power always goes off just before the sun goes down.
On the coldest day of the year.
There's, I would, with the business continuity plan, and it's not finalized, but it's getting close, with the addition of Pension Goal Secure and having the ability to call LRS and say, we're down, we need you to print checks. And there are 4 critical operations that we have. It's to pay the ACH benefits, to cut the checks, the end of month checks, the few that we have. There's also the funding for that, which LRS can't do, but we know exactly how that will work if it needs to. And the other critical operation, believe it or not, is sending out 1099s, because the IRS is not very forgiving when they give you a deadline.
Once a year.
Once a year, but if something happens, that can become a critical operation. So we have the ability to call LRS and say, we need you to do this on this date or however it works. I think that gives us a lot more coverage in terms of being able to continue our critical operations should something happen.
Do our customer clients, does their year-end statements state on how much interest they've received that, or how much benefit they've received that year? So they don't really need a 1099. I mean, they get a 1099, great, but they don't have to have it because they already know what the number is to put on their tax return.
Right.
You have to have it by April 15th.
Well, you don't have to have it, you just put it on your tax return. I mean, we're supposed to issue one, but if there was some delay, they do have the information. I mean, my former company issues hundreds of 1099s. So.
I guess I think you're hearing there's some dubious thought around a $30,000 generator. But as part of the business continuity plan, let's pretend that on the day you need to do 1099s and cut the checks, the power goes out. And the locks on the building don't work. What's going to happen? I mean, and maybe that's just it. What's the protocol?
And somebody's going to steal the generator.
So
serious.
Well, no, we have a
$10,000 generator right outside your door.
Yeah, in this day and age. But,
so the general framework for our working plan. So 1099s are supposed to go out, and we're issuing month-end retirement benefits.
Yep.
I'm going to create a almost worst case scenario. And those 2 things are supposed to happen on a Monday. Over the weekend, the building at 625 Kings Court is leveled.
Generator won't do you much good.
The protocol is there's going to be communication amongst the staff to determine what we're able to do and how we're going to do it. So the funding and the ACH can all be done remotely via telework. The printing of checks cannot be done via telework, and for that we would engage LRS with PG Secure and have them do it. The 1099s,
Hopefully you didn't wait till the very last day that you were gonna send this 1099 back.
We're not. We actually don't mail the 1099s ourselves. We have a contract with a printer, and we send the printer the data, and they do print the forms and mail them for us. And if we can't do that, then under PG Secure, LRS can do it for us and mail those out. So we have the ability with telework, if it's only a physical asset impairment, to do most of what we need to do and reach out to LRS to fill in the gaps. If there's a human capital impairment, then it gets a lot more dicey. But a generator will help us in that situation anyway. So,
Now, what were the 2 occasions when you used your generator?
Storms.
So if we talk ourselves out of this?
Buy a backup printer and store it somewhere. It's jazz.
I think we're hearing we're in a lot better shape now than we were.
Yeah.
Yes.
absolutely,
Yes.
absolutely. I would definitely say that.
I would say we sell the building and make it a condition of the sale that the new buyer puts in the back.
It works when the building's flat.
It's all in the red, you know? No free lunch.
Okay, so do you feel you have direction on?
I do not feel as though I have direction. It would
It
take.
generated a lot of discussion.
Shocking.
To get the information would require the expenditure of a little bit of money to have a contractor come out and assess what we would need and put together a spec sheet, if you will. I don't know what that would cost. My guess is going to be $1,000 to maybe $2,500. But that is an honest estimation at its finest. So if the board's comfortable with where we are, we'll just go on down the road. Or if you want more information, we'll have to spend a little bit of money, but we'll happily get that and bring it back to you for further discussion.
I'm comfortable where we are and don't think we need to spend time or money on picking up further.
Yeah, I'm comfortable where we are. Why don't we get his generator? He's only used it twice.
$500. $500. And you change the gas.
It runs the welder out in the field though.
Okay, so I think that there's direction. We're comfortable where we're at. We don't need that.
Okay. All right. Fiduciaries Forum, if anyone's interested, let Judy or I, Judy, especially Judy know, and she can help you with registration. And as the legislation, but I'll make Jeff answer any questions there. That completes the administrative report. Judy, was there anything else I was supposed to mention or discuss?
I know for those who are going to Sackers, just remember what you did. Finish up all your travel plans.
Yeah, what are the,
Quickly approaching.
what are the travel,
Did you sign up?
let's have that going, that's a
You're
cover.
going. So,
No, Pepperdines over.
this one's in November. That's why our board meeting.
Okay, so then final thing on the agenda is general board member discussion. Are there any general board member?
I have.
Go ahead.
I went through a bit of frustration this morning as trying to get my stuff back into the computer and realized part of it was that our agenda and our staff reports aren't read up, I mean, how do I want to put this, aren't simply labeled. And as you look at our agenda, we have item 1, consent calendar, then we have 3 bullet points. We have item 2, item 3, it has 4 bullet points. Item 4 is by itself, et cetera, et cetera. And then where those bullet points are, I think it would be helpful if those were labeled like A, B, C, item 1, A, B, and C. And then the follow-up would be on the actual report, that there would be a box in the corner that said item 10A or 10B or 10C. And that way, if you flip through these online at the very top of the page, you'll identify, oh, that's the wrong item or that's the right item, depending how skilled you are about running an Apple computer when you only do it once a month because you work PCs and everything else. So it's just a minor suggestion for modification on our identification of our agenda and our staff report.
And I would agree with that, because knowing that the internet may not work here, the Wi-Fi, I had downloaded everything onto my computer, and when I downloaded it, those bullet points got me out of order and stuff.
So it would be helpful, very helpful.
Okay. We will take that under advisement and
Well, we should mention that we're currently scouring all of our documents for accessibility, so ADA.
oh, yes.
So that could interfere. That will most likely interfere with the accessibility of a document. So we have to make sure that we can modify, make your changes, but yet the document still be accessible.
Accessible.
ADA
Like
accessible.
the print has to be a certain
Like,
size. or
Yeah,
a little
right.
emoji down in the corner.
Photos have to be named, like our logo has to have a name.
A screen
And
reader.
if you're visually impaired, you have to be able to use your reader to read these documents, and we're required, we have an upcoming date for that requirement. Actually, no, I think it's even in effect now. So we're currently revising all of our documents.
So I might declare them inaccessible currently to my disability due to age, yes.
I want to second that because I can't select those little things with my arthritis in my hands. I keep getting the wrong one
Well,
going.
you know, that goes back to another point, and I noticed that Tim had enlarged his agenda so those things were big, and you can use your foot on it. So, well, again, when you are used to a keyboard and a mouse, and you're not used to all of this, and realizing you have to hold your finger there for a count of 2 and then do that.
It is.
But that's my own issue.
Is this a personal problem?
It is indeed. It's one that started the day badly. But if that can be accomplished in
We'll take it under advisement.
Okay, Calvin.
I just wanted to report that I did attend the Calipers Pension, Principles of Pension Management for Trustees at Pepperdine, and it was a very valuable experience for me. Patrick had recommended it, and, there were some sessions on things that I felt like I was already an expert in, like, board governance and ethics and things like that. But the sections on investments and on actuaries, I could have used a whole lot more time on actuarial information, but it was a very valuable conference if anybody is looking for something that can really help them with this job. But I also wanted to say, and I'll pay James a compliment here, he was one of the presenters and he was there the entire time and interacted with all the other presenters who most of them were either attorneys that were hired or worked for other pension plans or other executive directors or CEOs of pension plans. And I would say, besides, I will say James had one of the top presentations there. The way he presents and the way he uses humor and comparing him to all the other presenters. I did like Paul Angelo though.
You can't beat Paul.
Yeah, but,
You're trying.
but James did an exceptional job in watching him interact not only with the other presenters, but also with the other attendees. There were probably 30 or 40 of us, I don't really know. I want to say in preparation for talking about his contract next month, that he is way underpaid compared to all those other folks. I looked up their salaries, and there were some people there that couldn't present as well as he did and didn't know the stuff as well as he did, and I looked up their salaries later, and they're making $100,000 more than we pay our executive director. So just so we know that.
Would you pay her to say that, James?
Yeah,
He hasn't yet. I'm gonna have to see what I can get out of him.
he's good at dinner.
Yeah. But it was a very good conference, yeah. My only regret is that we had wonderful views from our rooms, but Pepperdine sits so far up on a hill, you didn't have time to walk down to the ocean or anything, because they gave us no time. We had meetings after dinner and everything else, but it was just a beautiful location to have an event for trustees.
Okay, any other board member comments?
Thanks for coming to Fort Bragg.
We had a big audience.
It was wonderful, the weather's beautiful.
Yeah.
I mean, can't beat
Like
that.
this here every day.
No.
Every day. Every day but August.
Well, I did mention that the fall is usually the best weather. At least without a wind and most sunshine.
September, October, and November.
Okay, 1:45 before adjourned.
So we skipped that one item altogether.
The presentation.
I'm happy to do it.